They're citing macro factors. They're also citing the geopolitical volatility that we seem to talk about on a day-to-day basis, and Deliveroo in focus. Weak guidance also an issue for that one guy.
Here we go. 10 seconds until the European Open, which is going to be influenced by the US Open, I suspect. Futures are quite negative in the States. How does that feed through into Europe this morning? Let me show you. Time for the opening trade. These are the first numbers. Let's take a look at them, give you an idea of what is going on. A negative print out of the gate for the FTSE 100. You could expect this to be replicated elsewhere across the continent this morning. The US futures picture is being influenced by a bunch of factors, one of which, of course, is what is happening in Washington and the government shutdown. Stock 600 actually comes through flat. There's a little bit of green on the screen. We'll see how long that lasts. The expectation is for a, let's call it, circa 0.5% down move, maybe across Europe this morning. Does it turn out to be as negative as that? Well, the CAC's certainly not moving in that direction. We're down by 0.1%. The IBEX, though, may be more consistent with that narrative, down by 0.5% at the moment. But we're trying to think about how the US Open is going to influence Europe. There wasn't much steer out of yesterday into Europe this morning, so we're kind of looking ahead a little bit to what could come later in the session Thursday for the US, Chrissy.
Absolutely. When I'm looking at these markets and what's driving it, it's a tale of two tech stories, and I think this one's interesting here because when you look at the downside, of course, tech is weighing the market down. We're seeing that in the NASDAQ futures as well that continue to drop. So names like ASML, SAP, even ASM in the chip-making space, all pulling this market down. But you have a couple of standout outperformers as well, along with the defense trade that's showing up as the outperformance, the likes of Schneider Electric. So to me, it feels like this market is quite divided on what's moving. But net-net, you are seeing underperformance across Europe, Anna. Telecom and healthcare having a good day, but perhaps because those were the underperformers in yesterday's session.
Yeah, absolutely. Retail was a big underperformer in yesterday's session as well. We were really focused on the consumer-facing things, weren't we? Healthcare is doing well. I wonder if there's a bit of that M&A in there, even though we don't have an opening price on Gerresheimer, and it's not the biggest business, but there is some private equity interest there. And that's interesting. So that's, you know, a defensive sector, isn't it? And it's at the top of the gaining list today.
The breadth is really horrible, though. So you've got 137 stocks up at the moment in the stock 600. You've got 432 stocks that are lower this morning. So if you take a look below the surface and take a look at the breadth, that's pretty poor right now. You've got 30 unchanged. We'll see which way they come through. There could be some critical stocks in there. At the moment, in terms of the points, it's Volvo, ASML, NatWest, LVMH, BBVA. So there's a real mix of stocks moving on the downside, which tells you about that, speaks to that breadth story, that a lot of things are lower.
And I wonder if autos is the weakest performing sector, and I wonder if that has to do with the threat of another round of tariffs coming from the White House. So no, it's not news that President Trump is wanting to impose tariffs, but the fact that he said, yes, we'll go again. We did ours, Europe's doing theirs, we're going to take them on again on tariffs, so that perhaps adds up to a little bit of a leg down for autos.
The defense stocks are doing the heavy lifting. Yeah. So yeah, Nova's up, Schneider's up a little bit, but then you get into, there's some banks up as well, but Rheinmetall, Safran, Airbus, Rolls-Royce, BAE Systems, Leonardo, these are the stocks that are doing a lot of the heavy lifting on the upside. Feels like a defense story that's lifting Europe. Everything else certainly doesn't paint such a positive picture at the moment.
Absolutely. It's interesting, though, that the auto sector, including all the early indications of Volkswagen shares, aren't actually moving to the upside because we did have this story of this kind of reshuffling of capacity when it comes to the auto sector to the defense sector. I don't know how you trade that in this market, but of course, as we are really kind of looking through all of these various drivers of the market, we are still awaiting the DAX, which I should mention has not opened yet, but we are seeing some of the initial movers in the stock 600. So when we do get, and the DAX has just opened, as I'm speaking, down about 0.4%. But again, not that massive pull down that perhaps we were expecting. Let's bring in a true expert here. Florian Ielpo, head of macro at Lombard Odier Investment Managers, joins us around the table. Pleasure to have you on the program. Thank you for joining us. We are waiting for what that buy the dip signal is. What is it in your view?
First of all, thanks for having me. What's odd with the current market move that we haven't seen this layer of liquidation that usually ends the kind of trend in which we've entered over the past, 2 weeks now. What we would need for that is, either a definitive macro bad news. Maybe we'll have a bit of that with the PPI today, but it's very unlikely. The retail sales in the US would be probably the occasion to see like a slowdown in the US really materializing. But so far it's purely speculation. So far it's purely sentiment. At the moment, the way we see the situation is rotation, not recession. And it's a very important thing when you see this open this morning to remember that something's up there, the triple layer, the rotation that's currently happening, and one of that layer is out of the US towards Europe. Now, Europe this morning is getting a little bit shaken because Europe hasn't faced so far trade theories for good. We haven't had this genuine exchange that Canada and Mexico have had with the US so far.
You talked a little bit about the rotation. JP Morgan is making the call that the bottom is in simply because a lot of this deleveraging has already taken place. Are you seeing evidence of that?
I think there is a lot of speculation around hedge fund selling their position, triggering that movement. I doubt that this is what's happening. What happens with hedge funds, like their short position getting covered, is usually a market move and not their longs. Now, if you've been looking at the AAII survey, which I tend to see as a retail investment survey, you've seen a sharp decline basically in February. So I suspect also that retail money has been exiting the big names driving the NASDAQ, and that is creating some kind of contagion feeling that we can see this morning. You see, retail money is difficult to measure, but you can suspect that it's been playing its own role recently.
But you're not seeing this kind of liquidation story that you would need to see for a bottom to be in?
No, we're just out of our investment committee, so it's quite nice to be with you this morning. We have diverging views, of course, but most of our PMs are saying we're calling for resilient portfolios. We're calling for cautiousness, not defensiveness, because we haven't seen that last leg of a natural, highly valued liquidation market. And we need to see that to be...
How ugly could that be?
With a recession, without a recession.
Okay, with a recession, how ugly could it be?
With a recession, you could see Ps in the US go back to the range of 16.
Wow.
So that would be large. It's 4.4K, something like that on the S&P. That would be a very big call. It's not our call at the moment because, again, we're not seeing this recession happening in the US. What we're seeing is a slowdown in the US, but the rest of the economy is doing quite nice. The Europe is recovering, China is recovering, and all of that is creating some kind of a rest of the world put. We don't have a Fed put, probably because of tariffs. We don't have a Trump put because he cares about rates more than equities. All we've left with is basically this rest of the world put. But it's happening. The recovery is there, and the difference in terms of fiscal spending in China and Europe is massively different from the US.
So you mentioned in your notes, and I think it's just we're starting to get to that point in the conversation where this is US exceptionalism, but by a very different definition. A different version of US exceptionalism, a less positive version of US exceptionalism. And you talk about that because of the way that the US economy you think is slowing, how it's fiscally consolidating, the Fed's in a different place, and there's a lot of rotation happening within the United States. But how far through that story are we already? Or does it have a long way to go? Is that going to be the story of 2025?
That's pretty much the story of the year. The story of the year is what Scott Bessent mentioned. The US have created a dependency of public spending, and he wants to get rid of that. That's Doge. It's a very stringent impact on the US economy. It's called active fiscal consolidation. And usually it's a call for going away from risky assets in the zone where that fiscal consolidation is happening. So what we're progressively discovering is that this can happen in the US. Now, the good thing since the beginning of the year is that it's a unique story in the US. Europe is willing to spend more. China is clearly willing to spend more as well to stimulate consumption. All of that is creating an environment that makes it possible for investors to go away from US assets towards European and Chinese assets.
Sticking with the US for just a moment, do you see the argument coming out of the White House? Do you buy into it, the sort of economics of it, that there might be short-term volatility, don't worry about the ups and downs in markets. This is about long-term reinventing the US economy, about reshoring manufacturing back to the United States. Is that something that can play well for the US economy?
I'm going to quote one of our PMs, the Dhiraj Bajaj, CIO of Asia. He says he's been observing China for a very long time. What's happening in the US has a lot to do with what was happening in China, meaning a transition from one type of an economy to another. And this transition period can be costly. So we come from this big tech ETF, which is the US at the moment, and he wants to recreate an industrial United States. And that will take time, and that comes with costs.
Costs, benefits too, or just costs?
And benefits. What's the big difference also with China? When China did the transition from export to consumption, is that China is a closed economic space, which is not the case of the US. So as we will see better prospects in the US, outside money could be flowing back into the US economy for equity reasons, basically, which would protect potentially US equities. I'm sorry.
We've been talking about Germany this morning a lot. There's a big debate starting today in the Bundestag. Friedrich Merz is calling back the old parliament. He's trying to push through his big new spending plans before the new parliament takes over. Big vote coming up on Tuesday. Europe is outperforming at the moment. If Merz's plans go through, does that outperformance continue? Does it get put on steroids? Does it go even faster? If it doesn't go through, does that outperformance go into reverse?
We doubt that. We had a conversation like a month and a half ago, something like that. Our nowcasting indicators are very clear on Europe, are very clear on China. The macroeconomic landscape is improving. It has nothing to do with the political decisions that are currently getting decided, because basically it's not yet in the economy. So at the moment, we have a majority of economic data in Europe, which is improving, and it's a very important message to listen. Now, if you get another catalyst and with this kind of political decision, then it's all even better, and that would add to this European momentum. Probably that Europe will be at least the trade of Q1, Q2 this year.
Florian Leopold, nice to see you. Thanks for stopping by to see us, Head of Macro at Lombard Odier Investment Managers. Thank you very much indeed. Call 6 looks like this morning. In Europe, you are seeing a bid certainly into the defence stocks. Trucks are on offer. LVMH, Ferrari rolling over. ASML seeing some weakness. Everything else is kind of a little meh, except for the pharma space, which is having a very good day alongside the defence space. Trucks is an interesting area this morning as well. What's going on in the States with the EPA? Maybe having a ripple effect back here in Europe this morning. Joe's got all the details of the other stocks we need to be focusing on. What's going on?
So we have got some big moves in those truck stocks, Guy. As you mentioned, we're seeing Volvo, Traton hit at the open of trading. Really unexpected. Thankfully, a trader in my IB sent me a couple of links, and there does seem to be news, as Guy mentioned, around the US potentially rolling back some regulations around environmental restrictions, and that was actually seen as supportive for pricing in the truck space, according to some analysts this morning. So we are seeing that as a bit of a shock move and a decent move lower in Daimler Truck there. Volvo as well hit off that news, but a big drop. Daimler potentially going into a trading halt as well. Worth keeping an eye on that one, and keep an eye on the story on the terminal. That'll be out very shortly. Then, in terms of the retailers, we're over in Poland, one of the biggest retailers in Eastern Europe. Allegro reporting some sales, and that was the best performing stock on the SXXP at the open of trading, and it is gaining on better than expected sales for the grocer, so a bit of a boost for that one. We're up 6% at the moment, as I say, and also doing a bit of a buyback as well for them. Then a stock not doing so well was K&S. Now this is over in German chemicals. Of course, the German sector had a bit of a boost recently, given all the spending, the government fiscal spending, but K&S reporting weakness once again. So agricultural chemicals is the main exposure there, and looking soft on the margins and outlook for that company. Then analysts are frantically trying to upgrade their price targets on Rheinmetall. They're all trying to outdo each other this morning. I've seen UBS went to 1,600. I think a couple of minutes later there was another one coming through. So Rheinmetall, once again, we're at 1,300 for that stock now. Earnings yesterday looked very strong, of course. And then we also had the Jefferies initiations coming through as well. We've got SSAB on the screen there, potentially a little bit of exposure in that space as well. Then in terms of the analyst rating changes, the one that really stood out was Schneider Electric. That was up around 2% at the open of trading, but coming back down a little bit. Goldman says that the sell-off tied to the data center worries is overdone. They think the bear case scenario is fully priced in for the electrification stocks, and therefore they go to buy from sell. A double upgrade. We love a double upgrade, and that one is up 0.4% in Paris this morning.
Joe Easton from our equities team, we thank you so much walking us through some of those early movers in the European session. We certainly appreciate it. At the same time as the European markets open, of course, the U.S. pre-market has opened as well. Let's get a quick check on some of the stocks that are moving in that space. A lot of that concentrated in the tech space. Now, Intel is going to be a key one. Shares higher by, get this, a whopping 9%. They were up 8% yesterday. So this is a really big deal. They're talking about a new change of guard when it comes to the CEO over at Intel. Pat Gelsinger no longer going to be leading that charge, trading at about $22 a share. NVIDIA and Microsoft, though, taking a little bit of a beating. Adobe remains unchanged. Remember, we are only 15 minutes away into that U.S. pre-market, so we'll see if that crosses given their earnings story from last night. But tech broadly down. Intel, Anna, kind of fighting the charge.
Yeah, absolutely. Big moves then anticipated in Intel. Coming up, we will stick with that tech theme, in fact, and discuss whether the Nasdaq is in oversold territory. We'll have charts for you. That's next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Welcome back. It is 8:17 here in London, and this is the picture on European equity markets. A little bit more selling, perhaps, than we were anticipating, at least if we were looking at futures. Certainly in Germany, we're down by 0.9%. The CAC 40 down 0.7%. Overall, though, Europe down just 0.3%. US futures are negative. A big tech theme running through the day ahead, it would seem. Nasdaq futures down by just over 1%. Is that to do with shutdown fears, really, in the United States? Is it other things on the agenda? Let's get to Kriti, find out what has caught her eye from a tech perspective.
Well, Anna, absolutely. Absolutely. I mean, that's where we're seeing most of the pain and the concentration in some of the selling. Now, some of this has to do simply the fact that tech makes up a good chunk of the S&P 500, certainly makes up a good chunk of the NASDAQ 100 as well. But this is where the momentum trades really come in handy, to the point that if you're looking for a place to spot, to say this is the point to buy the dip, technicals may actually come in handy. I'm going to take you on a walk through history, if I can, to show you how true that is. Because right now, the NASDAQ 100, that is really holding a lot of those mega cap names, is hitting a key point. It is in oversold territory when it comes to that relative strength index. And that's what these red dots at the bottom panel really indicate. Every time, going to the back 2 years, that we've seen it hit the spot, it has spurred a sense of buying into the index. And you can see it earlier in 2024, of course, the sell-off driven by the European kind of debt surge and spread surge that reflected into the States. You saw it really, a lot of it, specifically in 2022, when we know that entire year was a negative year for American equities and global equities, I should say. But it has consistently pointed, and you can see on that top panel, as a place where the market has rebounded, even just temporarily. Is this time different? That's going to be the key question, especially as we get a slew of earnings that suggest that maybe some of the kind of estimates aren't actually up to par when it comes to the AI investment, the monetization, and the return on equity. That kind of exceptionalism, not just in American stocks, but in tech, Guy, can it last?
Absolutely. So there's a whole range of macro factors that we're focusing on, trying to understand what implications they all have for where the NASDAQ and ultimately the S&P trade. Single stock stories, though, there are plenty of those as well, and one stands out this morning, and that is what is happening with Intel. Its stock is up 8.5% pre-market. It's off its earlier highs, but we're already seeing a significant bounce. The analyst community sounds reasonably positive as well in terms of what it is expecting from this new CEO. Lip-Bu Tan is the next chief executive. He's entrusted basically with turning this company around, a continuation of a process that has been very, very slow. He's a semiconductor veteran, but he has got now one of the toughest jobs in the chips industry. Let's talk about the big picture. Let's talk about what's happening with AI. Let's talk about what is happening with Intel more specifically, because Mandeep Singh is in Europe, global tech analyst at Bloomberg Intelligence. Great to see you. Haven't seen you for ages. Fantastic to see you here in London. So much going on. I barely know where to begin. Let's start, though, with Intel. How big a job does this new CEO have? How tough a task is there going to be ahead? He's talking already about sticking with the foundry plan. Presumably everything must be on the table, though, at this stage.
There is, and look, I mean, a guy like Pat Gelsinger, who had all the credentials, couldn't turn it around, so clearly this is tough. But I would say, you know, the fact that he's leaning towards keeping the foundry business, it was in the news that he doesn't plan to divest anything as of now. The easy, low-hanging fruit is a cost structure, because when you compare Intel to NVIDIA, AMD, Broadcom, they have 3 times more employees.
Wow.
3x the employees of all the 3 comps that I suggested. And their revenue is almost close to, like NVIDIA, we know, is a $200 billion run rate company at the end of this year.
It's just cut, that's the job.
I think the cost-cutting could be huge. At the same time, this administration, the U.S. administration, is really keen to bring, you know, manufacturing back and reshore some of the chip production. I mean, CHIPS Act was there during Biden administration as well, but I think there's more emphasis in terms of reshoring with this administration. And if NVIDIA and Broadcom start using Intel fabs, that could be a positive. It may not be for the leading node chips, but some form of external third parties using Intel fabs could be a near-term positive.
So good morning to you, Mandeep. Why do other analysts then put so much emphasis on the decision to keep being in the foundries business, and maybe they should think about not being in the foundries business? Why is that such a focus for some analysts?
Because the margins are terrible for foundry business. When you compare that to the core chip business that Intel has on the CPU side, I mean, foundry margins are negative gross margin. But Intel needs its own foundry. I mean, how are they going to make their CPUs? So it's on Intel fabs, and if they sell it, then it's going to be a cost for them. So clearly, I think the cost structure, the bloated cost structure, is the one that I feel he should fix first. And he's got software roots coming from Cadence. So clearly, there is that software angle where things can be pushed as well. But it's a hard job. I mean, we've seen that with Pat Gelsinger. So.
Well, Pat Gelsinger took quite a bit of advantage to those Biden chip grants, right? I mean, Intel was one of the major beneficiaries in terms of that U.S. manufacturing story. You haven't seen that in some of the other chip makers to the same extent. Does a Trump administration, did the geopolitics challenge or help that?
I mean, right now I feel the Trump's administration mandate is whatever we can bring back to America, let's do that. So if things are being made outside America when it comes to some of the chips, can we bring them onshore? And who are the options when it comes to, you know, chip manufacturing in the U.S.? It's either global foundries or Intel. And I think Intel clearly has more, I would say, fabs in terms of CPU side. So they have more leading node capacity than a global foundries does.
If he fails, is Intel done? Is Intel broken up? Does Intel cease to exist? Is it as big as that in terms of what we're talking about here?
I wouldn't rule that possibility out. I mean, look, there are certain acquisitions that Intel did back in 2014 to 2017 timeframe that you could argue don't really tie with the core business, even if you would decide to keep foundry. So divestiture is on the table, and that's why I said the cost structure should be paramount here.
And let me go to another story that caught our eye this morning, and this is around Microsoft. And the reason for this is the politics, a continuation of the politics. So Trump's FTC is continuing some work that we saw started by Biden's FTC, and this is all around whether Microsoft is reducing the level of competition around the AI market. How does this play out, do we think?
I mean, look, the closest connection I can make is OpenAI, Microsoft, and we all know Musk doesn't like OpenAI. He actually put in a bid to acquire OpenAI. So the fact that Microsoft and OpenAI really partnered at a very early stage, and you know, they have a 49% stake in the company. You could argue, is it stifling the competition in the AI market? What did it do to Microsoft's own investments in building their own large language model? And I do see that Musk angle because of how prominent he is in Washington, D.C.
Is there a liquidity story that works well for tech companies broadly right now? I mean, they're sitting on so much cash. The hyperscalers are investing it all in AI. Does that all come to a close if we hit a recession or tariffs or geopolitics? Does some of that cash crunch show up in some of these big tech names?
I mean, the good thing about all these hyperscalers is they generate a ton of cash. Even if we hit a recession, I mean, they can sponsor their CapEx, you know, with their own operating free cash flow. And look, are they going to pare back in terms of the CapEx investments? Most likely, we are hitting that wall when it comes to training. But this AI wave has a very long tail when it comes to
Just finally, very quickly, we got very excited about DeepSeek in China. Manus is the new story that we're talking about. Are we talking about enough? How big could it be?
I mean, AI agents is the new game, and every enterprise is looking to deploy AI agents. Manus is a manifestation of, you know, LLM being deployed as an agent, and we are going to see more of that everywhere.
All right, Mandeep Singh, global tech analyst for Bloomberg Intelligence, joining us here in London on a day where, of course, we're already seeing some of the pre-market moves in the tech space, already concentrated in some of the heavyweights. Intel bucking the trend, though, and that, of course, is a positive. We'll see how long that continues. Coming up, we're going to talk about one of our other major themes this morning, and, of course, in the last couple of months, financing Europe's rearmament. We're going to speak to the CEO of SmartCap, an Estonian investment firm that's launched a new fund for investing in defense and weapons technology. More on that next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? So I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Welcome back to the opening trade. About 30 minutes into today's session, seeing a little bit of negativity on the screen, but perhaps pairing the earlier losses. Stock 600 basically flat at the moment. But if you're looking for underperformance, look no further than the German index. The DAX is down about 0.5%. The CAC Iran down about 0.3% as well. But the FTSE 100 marginally in positive territory. We're only 30 minutes into session, Anna. Perhaps a little bit of a rotation from what we saw.
Right, yeah. And E-minis and NASDAQ futures still down, off earlier lows, but still substantially down on NASDAQ futures. We'll keep an eye on the tech sector as we get closer to US trading. Let's turn our attention to defense matters. European governments are planning to throw hundreds of billions of dollars at expanding and modernizing their militaries after President Trump called into question decades of US support for and security in the region. Joining us now is Sila Patai, CEO of SmartCap, which invests in venture capital funds and startups in green tech and defense within Estonia and across NATO member states. It is Estonia's state-owned venture capital fund manager. Sila, very nice to have you with us. Thank you so much for being with us here on the opening trade. So I think your fund has only recently come together, so a little too early to talk about what you're exactly investing in. But tell us what it is you're looking for. What are the things that you really want to see in the funds or the startups that you back?
Good morning, everyone, and I'm so happy to join you from Tallinn. Yes. The defense fund that we launched quite recently is all about strengthening Estonian defense industry. So what we can do, we can invest in a wide variety of companies from Estonia, but also from other NATO allies. But we need to understand what they bring on the table, how are they going to contribute to developing and strengthening Estonian defense industry. We can do deals from very early stage, from seed stage, all the way up to growth equity. So we have quite a lot of flexibility to provide equity financing to companies who are willing to play a role in Estonian defense industry.
Yeah. And Sila, can I ask you about the time horizons here? I understand that you take a slightly a medium-term or longer-term approach, investing for maybe decades to come, or at least with a view to the next decade. But Europe needs money spent on defence in the very short term, here and now. Is there a sense that money is diverted from funds like yours to more immediate defence needs?
Currently, no, but we need to understand what the market is. You described the increasing defense spending in Europe. It is true. 800 billion euros being channeled to European defense industry, and it is emerging, it is growing. But let's take a look. You talk a lot about the stock markets and the sentiment. For example, Warsaw Stock Exchange, which is a proxy market basically to Ukraine, it is performing historically at the best levels. The same for Ukrainian stocks on Warsaw Stock Exchange. The defense stocks in Europe are up more than 50%. So that's pretty much the sentiment and the increase in prices that we see in February. And is reflecting the geopolitical sentiment. So for us as defense investors and seeing an urgent need to increase the funding for defense companies, it is clearly a choice whether we sit in cash or pay to play.
Okay, let's talk about potential areas of investment, clearly within the defense space. The Baltics, Estonia, have very strong tech sector that has emerged over the last few years. How much of what is being done there is transferable into defense skills? What is the crossover between the two? How does the Venn diagram overlap between the tech sector and the defense sector?
Maybe I'd zoom into Estonia, which is very tech-savvy country. We have extremely successful technology companies, technology sector and ecosystem. #1 in terms of unicorn companies per capita in Europe. So we have a lot to build on, and we understand where our strengths are in tech sector. So that's what we need to do, because we have no legacy industry in defense in Estonia. We need to turn this into opportunity. And again, use what we have in technology sector. And that's what we also see. If you look at the companies in our pipeline and that we are screening through, there are around 300 companies on our radar, around 100 of them from Estonia, and dominating technologies that we see. Roughly 20% are unmanned vehicles, roughly 20% cybersecurity and software, and the third one would be any kind of situational awareness technologies and solutions, or enabling technologies like sensors. Yep. So these are closely related to the talent pool.
Yeah. Is it easier to scale those areas? Cyber, drones, is it easier to scale up quicker in this space than maybe it is in heavy armor, tanks, those kinds of areas that the prime manufacturers like Rheinmetall are into? Is this an area that can accelerate from a standing start at a much quicker pace?
Definitely, especially when we see more innovative and advanced manufacturing technologies being brought on the market. But when we look at the newcomers and new defense technologies, what they have a very small and lean product portfolios. What they can do with very advanced manufacturing solutions, they can bring down the manufacturing time and they can bring down the cost, but also increase speed. So there is definitely an advantage or edge. And when we talk about primes, they're busy producing and delivering orders. For example, for most of the primes, their backlog is around 3 years. Let's take Rheinmetall and their numbers for 2024. The revenue was around 10 billion, backlog 55, which translates to 5 years of backlog if we assume the same sort of capacity.
Celia, it's Kriti in London. Walk us through kind of the scale question here. I mean, we're talking about private financing in the defense sector, any sector in Europe. One of the big things this part of the world has struggled with is really scaling up with some of the bigger players coming out of the United States or arguably China as well. Is scale or the size of investment a barrier of entry?
It's becoming less and less of a barrier. And we need to make a difference here, whether this is emerging tech company, defense tech company, or more established with revenues. Because not just equity financing, but bank financing, traditional loans. They look for bankable companies with solid revenues and estimates. And that's what the emerging technology companies simply don't have. So they have, the access to bank financing is basically non-existent, but you need to blend it. But what I see that the emerging tech companies are doing really well. They're blending their financing well with grant and non-dilutive financing.
So let's continue on the topic of that barriers of entry. You just made a key point there of what that partnership with traditional financing and banking actually looks like. The EU has a lot of red tape around what collateral for some of these defense deals look like, specifically around traditional banking. Does that limit perhaps the kind of traditional financing that can be partnered with when it comes to the private markets?
Maybe not the regulative or restriction and limitation side, not anymore, not in this region. We have close ties with local banks. That is not the question or number one issue. It's more whether the companies are bankable. Are they able to access bank financing because of their financials? What is the ownership structure? What are the revenues? How diversified is their customer base? And then we get to the procurement issues and very limited number of end users.
We look forward to seeing how this all unfolds as, of course, the story continues to unfold. Seal Patai, CEO of SmartCap, we thank you so much for joining the program this morning. And sticking with that defense theme, a reminder that later today, the CEO of Thales, the French aerospace and defense systems maker, will speak to our colleagues over in the States. You can watch that exclusive interview just after 4:30 p.m. UK time. Guy.
So in light of all of this, let's talk about something that is emerging and beginning to emerge a little bit over the last few days. So Donald Trump's rapprochement, call it what you will, with Vladimir Putin. Investors are now trying to figure out whether or not there is a tradable story of this, i.e. whether Russian markets will open to the West. It is the topic of today's Big Take, and Bloomberg's Tony Halpin, who leads our Russia economy and government coverage, joins us now to discuss. Good morning.
Morning.
How speculative, nascent is what we're talking about here? How early in the process are we in people thinking about how to reorganize Russia being part of an economy that it's not been part of for a really long time?
Yes, I think what investment companies and traders are discovering from clients is a kind of spike in interest to try and get hold of Russian assets in some way, on the anticipation that if there is a deal, sanctions might be eased or lifted. But it's still a very early and risky bet, because we just don't know how these talks are going to pan out in the end and what the final state of any settlement would look like. But clearly, there's hundreds of billions of dollars at stake in terms of assets and investment opportunities and trade. So people are willing to make this risky bet on the anticipation that they may make big profits.
That's really interesting. So who is willing to make that bet then, Tony, when we're thinking about sanctions still being in place? I mean, even US sanctions, for all the talk, US sanctions are still in place, and there's even been talk recently of, well, we could put those sanctions up if Russia doesn't do what we want them to do. In Europe, there's been no suggestion yet that sanctions are going to be rolled back. In fact, we saw some expulsions from Russia, Brits expelled from Russia, and then Britain expelling some Russians. Things are not looking as if they're getting closer between Europe and Russia. Doesn't it feel really quite premature?
Yes, I mean, there's a lot of risk. I mean, some of the traders we spoke to, for example, were finding interest in Middle East family offices in trying to access different Russian assets. But you've just raised one of the key issues, actually, that there might well become a divergence between the US and Europe on the question of sanctions. The US, President Trump, has a much easier route to lift sanctions. He can simply sign executive orders in many cases that lift sanctions. In Europe, you've got to get consensus of 27 countries to undo the sanctions packages that they've put together painstakingly over the last 3 years. And there's less will, I think, in Europe to lift sanctions. They are very much siding with Ukraine in this, and they've seen a shift of President Trump towards Russia and towards a position of a mediator in this war. So there is a growing divergence of view, and that may become one of the risks that traders and companies face in the future.
Can we explore that hypothetical, though, that if that sanctions relief does come from the United States, but there is that divergence from Europe as well, what does a potential rehabilitation of Russia in the global economy actually look like? Is it stunted by that view from Europe?
Yeah, I mean, I think there are two issues here. First is Russian companies and traders, what they really want above all is access to the financial markets. They want some easing of the restrictions on dollar trading, which makes it a lot easier then for companies to get paid and to buy things that they need for their own companies. So in that respect, a US easing of sanctions would be very welcome news for Russia. But on the other hand, Europe was Russia's biggest market before the war. If that remains closed to Russian companies, then they continue to look east towards China and to the global south. And that's something that some companies are becoming uncomfortable with, because they just want to ease their overdependence on China. They're worried about that. So again, if there's this divergence, if the US eases dollar sanctions, that makes trade easier. If Europe keeps them, then that makes trade a bit more difficult in terms of diversifying their customer base.
And for global businesses, that makes it difficult to decide what to do, I suppose. If they have exposure in Europe and the US, they might have to comply with both varied sets of sanctions, which would become difficult. In terms of what the thinking, the thought process is around these investors who have the risk appetite to go ahead and do this kind of thing, you don't know where the money's going to go, do you, essentially? And the story makes that point, that you don't know where in the Russian economy your money ends up, perhaps.
Right. I mean, there's big reputational risk. For example, I mean, you have to remember that Russia is still the country that began this war. Hundreds of thousands of people have been killed or wounded. Millions have been turned into refugees. You know, this is a reputational issue for a lot of companies with stockholders. So that's a question which they have to wrestle with. The flip side of that is that Russia isn't necessarily going to be as welcoming to Western multinationals coming back into their market as they were before, because there's a lot of resentment about the way companies left the market. While they've been away, other companies, particularly from China, have filled the domestic demand. So it's not as easy as simply opening the door and expecting people to welcome you with open arms. I think there's going to be a lot of friction.
Okay, Tony, thank you so much. Thanks for bringing us that big take story. And I can see it in written form and also an audio version, of course, a podcast to go alongside it on the Bloomberg terminal and on the Bloomberg website. Thanks to Tony Halpin for bringing us the details. Coming up on the programme, we'll get back to the banking story in Europe. Deutsche Bank bonuses rise to a decade high, driven by a surge in deals and trading. More on that next. This is Bloomberg.
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to Thursday morning. What's happening out there? Well, actually, the equity story is a little bit more positive, you could argue, than it was a little while ago. We are coming back off the lows. You've still got pretty negative breadth, though. You've got, in the Stock 600, 226 stocks up, down 364. That was a 400 number not that long ago. The trucking sector is actually under a little bit of pressure. This appears to be based on the idea that the US is changing some EPA rules, which is going to ripple across into the investments that some of these big truck companies have made. That's being taken as a negative. On the upside, you've got a bunch of defense stocks that are doing reasonably well. Some of the pharma stocks are doing reasonably well as well. But Europe is off its lows, but not by much. The Stock 600 is up by 0.05%.
Excellent. It's a day where we take stock, perhaps, waiting for the big stream of news flow, which we know is coming. We know it's coming.
Deep breaths.
Yeah, deep breaths, exactly. We've had some news flow surrounding the banking sector in Europe, so let's get to that. Deutsche Bank bonuses rise to a decade high as Germany's largest lender increased its bonus pool to €2.5 billion. That's a 20% increase from last year. For more, we're joined by Bloomberg's Jenny Serrain, who tracks, of course, the banking sector for us, the financial services sector here in London. Jenny, let's well, what is driving this? Earlier, I was talking about how banks over the last decade, they did quite well for a lot of years on those net interest margins, but this is not really about that. This is about traders. This is about deal making.
Yeah, no, I think that's exactly right. So last year, sort of towards more the end of last year, as it kind of became clear that Trump was going to be in office and there was all this enthusiasm, we saw a real pickup in both capital markets and deal making activity, and that's what you see coming through here today. And I also think a lot of these banks kind of have to think strategically about this year. And so knowing that they're likely to still see a lot of that same activity, they need to kind of keep these people well paid, keep them in seat, make sure they're there so that they can kind of, take their slice of this very fast growing market.
Would this number be as high if London hadn't changed its bonus rules recently?
It's an interesting question. We're still kind of seeing that play out. So, yes, so now in London, banks can pay their folks. It used to be that they were capped at paying it, 2x their base salary. Now they can pay it more. The European banks haven't moved as quickly to do that. But obviously, if your competitors down the street have given their folks really big increases, you're kind of under pressure to do the same. And so I think we are seeing a little bit of that, and it'll be interesting, especially, once we kind of have a couple more years under our belts to see how much actually folks are getting paid more.
Is Deutsche Bank the tone setter here for some of its peers?
I think a lot of these banks have been making similar moves, and I do think sort of they all have to move in tandem on this. One can't pay a lot because they'll just get all the talent, and so they kind of move in lockstep generally. Deutsche Bank did have products, though, last year that performed really well. So the fact that they're huge in fixed income, they're a really big DCM house, those are products that did really well, and so that's a place that will have a bonus pool that benefits more than a place that's maybe more focused on equities, which is still a little bit on its back foot. So I think they're in a good place for the products that they have, and I think generally bankers are feeling pretty good about themselves this month.
A very well followed story, I'm sure. Jenny, great to see you this morning. Thank you very much indeed for updating us, Jenny Serrain, on what is happening with the banker bonus pool story. Let's talk about what is coming up in terms of the day book. There's a busy day.
It's a busy day. It is, certainly. I feel like there's a lot of data on both sides of the Atlantic to keep an eye on. At 10 a.m. UK time, Eurozone industrial production data is going to be hitting the wire. Then, as promised, the focus over in the States. We got the CPI number yesterday. We'll see if we get the PPI numbers in line today or a major divergence in terms of whether or not they're pricing in some sort of front-running of tariffs in the States. Jobless claims as well, certainly in focus around the concerns around the labor market in the States. And then on the geopolitical front, two things to watch. The EU-South Africa summit, where Ursula von der Leyen will be attending. But then over in the States, Mark Rutte, the Secretary General over at NATO, meeting Donald Trump. So some interesting conversations on both fronts.
Okay, so he's maybe thinking more about, President Trump this is, maybe thinking more about Ukraine and thinking about defense today rather than tariffs, but we're always braced for more tariff news flow. And with that in mind, the person that every country seems to want to get a meeting with right now, the Commerce Secretary in the United States, Howard Lutnick, we are going to have an interview with the US Commerce Secretary at midday London time. That is on Bloomberg Surveillance, so stay with us for that one. Let's bring into the conversation Valerie Teitel, who is always on tariff watch and watching for all of the data data today. The data which follows on from CPI yesterday. We go more to the factory side of things and PPI today. What story are we expecting to be able to tell around inflation?
Well, it's a fairly nerdy inflation story today. A lot of the components that came in soft in CPI yesterday are not ones that feed into PCE. So now our eyes are very much on this PPI print. Will we see some of those components that feed into PCE, such as airfares and healthcare? Will we see those come in soft, and will that maybe underscore the market reaction yesterday to CPI? We see maybe another boost to the equity market, maybe see front-end treasuries rally as well, because we are getting close to that Fed meeting. Remember, it's next week. Perhaps today's print will cement whether they want to keep that door open for a May cut or not.
So the market's looking for an excuse to buy. The pod shops apparently have been a factor in the downturn. Maybe this is all technical, and that's what we need to look at. But people are looking for a reason. Are we seeing one yet?
We're always looking for a reason to be optimistic, Guy. Yeah,
in equities.
in the equity market. JP Morgan with a note out calling for buying the dip, saying that the worst is over for the U.S. stock market. And the reason that they did that, reason that they're saying that is interesting. As you mentioned, they are seeing more of the equity retracement in the last few weeks due to deleveraging from hedge funds. And that's been mirrored in a lot of reports that we've had recently. Citadel, Millennium seem to had terrible February, one of the worst in a few years for those hedge funds, which are known to perform quite well during volatile times. So yes, if that was just deleveraging going on, hey, maybe risk on today. But it seems like the equity market for now has been reacting very swiftly and very volatile to any new news on the tariff front. And with that, guys, I think the market is going to be paying attention to what we hear from Howard Lutnick in a few hours' time when he joins us on Bloomberg TV.
Yeah, it's a fascinating one. We know, of course, a lot of the smart money was already overly concentrated and very crowded in the tech trade anyway, which has been driving a good chunk of the losses. But does that mean that tech is no longer the hedge in the face of deficit news, trade news, tariff news? What's the hedge here?
Yeah, that's a good question. I think a lot of it's been said that gold has been the favorite hedge. It has underperformed of late, but I guess it goes back to what exactly are we hedging for? Are we hedging against tariffs, or are we hedging against the possibility we don't see these tax cuts come as soon as we come from? Those are going to be two different things you're going to look out for. I, for one, it maybe is mirrored with the market. We want to hear less about tariffs from the Trump administration. We want to hear more about the tax cuts and the more pushing to deregulation. With that, guys, we know that Trump is likely to push for a new bank Fed cop sometimes later today as well.
It's interesting on that note. Yeah, we want to hear more about the tax cuts, perhaps, but the media were pushed out of that meeting with Wall Street and executives from business just days ago that happened in Washington. So we get all the public commentary, which is a lot of it around tariffs, and we didn't get to hear all of. We've had reporting, of course, from people in the room, but
the tax cut story is bogged down, which is really interesting. They're really struggling, the Republicans, to push this through. You've also got the shutdown story, which you've got to fold. The buy the dip, does that get affected by a shutdown? Monday morning we come in, government's not working.
These things always go down to the 11th hour. I think the market's kind of tired of dealing with it. Obviously, it's something you have to keep into account if you want to buy the dip. But maybe this retracement today is a good opportunity to get in.
Do you want to take that risk into the weekend when the potential government shutdown is sitting there?
Yeah. And with it so much on the Democrat side, the assumption always is they maybe don't have the nerve quite, because maybe their worldview is more favourable of government spending, don't have it in them to sort of send us really over the edge with a shutdown.
Yeah, absolutely. And certainly something that's weighing on those futures stories as well. Futures in states at least down about 0.5%, but a lot of that concentrated in the NASDAQ as well. Bloomberg's Valerie Titel walking us through some of the dynamics for the next 24 hours in these markets. Now, of course, we have talked plenty about the tariff story, plenty about the defense story. If you haven't heard enough already, Bloomberg TV does have an interview with Howard Lutnick, so we'll see what he has to say on that tariff front. That does it for the opening trade. The brief is up next. Stick with us. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Real World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York City. I'm Danny Berger. Manish Krani is off this week. Welcome to Bloomberg Brief. Let's set your agenda. A game of chicken. Senate Democratic leader Chuck Schumer says the party will reject Republicans' funding bill. On shaky ground, concerns over potential government shutdown drag futures lower after a volatile session. And Intel finally has a new CEO. The appointment of chips veteran Lip Bhutan lifts shares in the early trade. Well, we seem to be selling into the rallies instead of buying the dip. That's what we got this morning. A decline on your future session, down about 0.4%. The sound you heard yesterday was the market sighing of relief. CPI coming in cooler than expected. At one point, equities had rallied 1.3%. But again, we give that back. The IIAA survey coming in at a 2-year low yet again this morning. JP Morgan writing, though, that the worst of the correction might be over. Treasuries, those struggled yesterday. Notable that the yields ended higher, even though we had softer CPI. Looking through that, we are little changed this morning. Your 10-year yield basically flat at 4.3%. Your 2-year yield at 3.98. Now, some individual stocks to keep our eyes on this morning. I mentioned Intel. That is rising in the pre-market session. We learned yesterday about the appointment of chip veteran Lip Bhutan as its next CEO. Those shares up 10%. Adobe to the downside, giving a disappointing outlook. Shares are down 4.7%. That disappointing outlook was for revenue growth in the current quarter. It has been focusing on monetizing its new Gen AI features for products like Photoshop and Premiere. Finally, rounding things out with American Eagle, those shares are also lower this morning in the pre-market session, down 10.5%. It reported a weak forecast, said tariffs may dent its margins. That overshadowed its fourth quarter earnings beat. We've got a great show for you this hour. We're going to be speaking with Toril Borsoni of the IEA, whose report has just been out. Concerned about their oil demand outlook, cutting that with the trade war ongoing. We'll also catch up with Marco Papik of BCA Research. Now, in Washington, D.C., Senate Republicans need 60 votes to pass their spending bill and avert a government shutdown this weekend. But Senate Democratic Minority Leader Chuck Schumer says that they, quote, do not have the votes, indicating that his party would block the bill. For the latest, we are joined by Bloomberg senior editor Bill Ferries. Bill, great to see you this morning. So it seems like we have a roadblock for the government funding bill.
Yeah, the clock is definitely ticking on keeping the government open ahead of that Saturday deadline. Democrats signaling they won't be a part of that 60 votes that's required to really get that legislation to final passage. There really is no plan B. The House is on recess now. It's unlikely you could get them back in 36 or 48 hours to come up with something different. But there's still time before for the Senate Democrats and Senate Republicans to try to find some middle ground here, perhaps allow the Democrats to get votes on a few amendments to the legislation that they would like, and then allow the bigger continuing resolution to go through. That would fund the government through the end of September. Right now, what the Democrats are putting forward as a counterproposal is basically a 30-day extension into mid-April.
We know that one of the things that they did in this bill to try to help it pass some of the Democrats is not include DOGE cuts in it, because that would probably be unsavory for a lot of folks. Considering it doesn't include DOGE, just how much power does this government task force have going forward?
Well, it's an enormous amount of power, but what's adding to that influence is the fact that there's been so little pushback from Congress as a whole so far. So you see DOGE going after federal agencies, groups like the U.S. Agency for International Development and others, and those are all congressionally chartered groups, but Congress isn't pushing back. So that has really given Elon Musk and the DOGE team a lot of extra influence in this process. If the Republicans who run the legislature, run the Congress, aren't pushing back, the process will just kind of continue forward. Democrats would like to see more restraints on that. It's hard to know at this point, with just a couple days left, whether they'll really be able to use that influence to get changes in DOGE going forward.
By the way, on the front page of the FT, they're running with new Treasury data showing that U.S. federal spending rose to a record last month despite some of the job cuts. Bill, I just want to round things out with tariffs, because there was a lot of news flow over the past 48 hours. What do we understand some of the retaliatory tariffs are coming towards the U.S.?
Well, we know the EU is pushing back on this latest round of steel and aluminum tariffs. They're talking about targeting about 26 billion euros worth of U.S. imports. They've talked about going after soybeans from the American South. We know in the past they've gone off after very iconic products like Harley-Davidson motorcycles and Kentucky bourbon. That's all planned to come in if there is not some breakthrough within the next few weeks. In terms of the U.S. tariffs, the big thing looming at this point is April 2nd. That's when President Trump says reciprocal tariffs will come on every nation around the world that charges the U.S. Tariffs for its goods.
We do get some pushback in the form of markets, that have gone towards something that looked like a correction. Or even if you look at the IEA's latest report, Bill, they're saying that there are fears of oil demand slipping because of tariff threats. The tone from the White House, though, has been one of not necessarily caving into anything from the market. What is the message that the White House is trying to send, Bill?
Well, the main message I think we've heard from this White House is they're not looking at the daily gyrations in the stock market. They're not worried. We know in President Trump's first term, he paid very close attention to that. So the big question is is whether that pain point has yet to be reached, if there is one. The Trump administration saying they're pressing forward with these changes. It's important to transition the economy to depending less on government spending. But if the markets continue to see red going forward, it'll be interesting to see whether that remains the messaging we get from the White House.
Bill, we really appreciate your time. That is Bloomberg's Bill Ferries. And don't miss our upcoming interview with U.S. Commerce Secretary Howard Lutnick. The surveillance team will be catching up with the Commerce Secretary at 8 a.m. Eastern. Let's get you some other top stories now that are trending on the Bloomberg terminal. Deutsche Bank has increased its bonus pool to $2.7 billion. That is the largest amount in a decade. It's also a roughly 26% increase from last year. A surge in deals and trading last year helped drive results. Deutsche also said that the pool was affected by a new system, which allows for a larger number of staff to receive bonuses. Elsewhere in banking, sources say that HSBC is placing some investment makers investment bankers on short-term retention agreements as it winds down certain businesses in a broad overhaul. The plan also includes cutting many of the vice chair roles in various markets. It still remains unclear, though, how many are affected by this latest move. Elsewhere, SpaceX has delayed the launch of a new crew to the International Space Station to help bring 2 stranded astronauts home. NASA and SpaceX said the launch was stood down because of an issue with the ground equipment used to support the flight. It is now expected to take place no earlier than March 14th. Astronauts Butch Wilmore and Suni Williams have been at the space station since last June, so they will have to wait a while longer. Coming up, what impact are tariffs having on crude? We're going to have more with the latest IEA report and the concerns about demand. We'll be catching up with Toral Borsoni next. Don't miss that on your Bloomberg Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Season is here.
It's quite remarkable what we've seen over the past few weeks. That's so exciting. Earnings season.
Bloomberg is first to break the numbers.
Alphabet earnings crossing the wire.
We do have some headlines from Redfin. Taking a look at Snap. More earnings rolling out.
With the smartest insights.
Economic growth is the driver of earnings. Earnings are the drivers of stock markets.
When you are priced at perfection or close to perfection, then I think there's a lot more scrutiny.
Continuing coverage on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in New York. The flurry of tariffs being unleashed in different announcements by the Trump administration is undermining the economic backdrop for oil demand. That's according to the International Energy Agency, who just put out their latest report. Let's dive deeper into that. I'm pleased to say that I am joined by Toral Borsoni, head of Oil Markets Division for the IEA. Toral, thank you so much for joining us this morning. So yes, you and the team write that macro conditions that underpin our oil demand projections deteriorated over the past month as trade tensions escalated. What is your estimation in just how harmful some of the tariffs, some of the trade war escalations will be for this oil market?
Good morning. So we're still trying to understand how everything will play out, but obviously the market is very focused on how escalating trade tensions may impact global economic growth and by consequence also oil demand growth. But our forecast for now is still underpinned by a GDP forecast on consensus of around 3%. And that translates into growth of about 1 million barrels a day this year. We have downgraded our forecast slightly from last month as we're seeing the readings, delivery data in the OECD and also in emerging and developing countries coming in weaker than expectations already at the start of this year.
So you're already starting to have some impact, Toril, but I wonder, is the bigger risk at this moment tariffs themselves, or is it the headline uncertainty? Is that the thing that's damaging to demand? If we get clarity from the White House, do you expect that some of that demand might normalize and come back into the market?
Well, what we're seeing is it's an unusual level of uncertainty, not just on the demand side and with tariffs and trade negotiations that are changing from day to day, but we're also seeing quite a lot of uncertainty on the supply side. We're seeing sanctions on Iran and Venezuela and Russia. We're seeing continued unrest in the Middle East. We're seeing compliance, OPEC Plus announcing to increase production from April, and the policy from the group beyond April is still to be determined by the group. So there's a lot of uncertainty in the market, obviously. Clarity is always a good thing, but it's a fast-moving market that we're watching very closely.
A few things to go through there, Toril. Let's start with OPEC Plus. As you say, they announced that they're going ahead with supply increases. We've seen member countries like Kazakhstan going even further than that. But I know the IEA is sticking with its cautious outlook that cuts might remain, or some form of cuts might remain in place. Is the market too fragile for OPEC Plus to proceed with supply increases?
Well, of course, there's still a lot of uncertainty in the market, but our forecast shows that global oil supply, even without further increases from the OPEC Plus group, would exceed our expectations for demand growth this year. As I said just before, we expect oil demand growth of about 1 million barrels a day, but you're seeing growth from the Americas, Canada, Brazil, Guyana, Argentina, and Canada adding about 1.2 million barrels a day of growth this year, which at the face of it more than covers the demand growth. So there's obviously a lot of tensions in the market. Non-OPEC supply growth 1.5 overall. Kazakhstan, as you said, producing at record highs at the moment as the Tengiz expansion project came online after many, many years of development and billions of dollars of investment. So the market looks well supplied at the moment, which is creating some challenges for further increases from the OPEC Plus group. And as the group, the alliance announced themselves, they will continue to monitor the market month to month and increase as needed. So until those increases are confirmed, we will wait to put them into our baseline forecast.
Well, Tor, as you've seen the U.S. moving to restrict some of its fiscal policy and some of these tariff headwinds, you see other countries shifting to a more stimulative policy. Europe comes to mind with the amount of defense spending they're going to do. China continues to talk about more stimulus that they want to put into the market. Are you seeing any signs that some of these markets might be picking up the slack for weakened demand?
That's obviously a possibility. We have seen that Europe increasing spending, and not just on defense, but also in some of the industrial sectors. And that, if that translates into increased economic activity, it can also shift some of the oil demand growth. But it's still early days, so we wait to see how everything plays out. For now, we're not seeing that increase translating into increased oil demand, but obviously these developments do take some time to play out.
Well, over the past 4 years, we've had these really momentous shifts for the energy market and the way that trade is rerouted, starting with COVID, then the war in Ukraine. Toril, in this moment where we're having another trade imbalance, we're having Trump focus rather on that trade imbalance and issuing various tariffs, are we entering another era where energy trade is about to be rerouted, where the global energy trade at the end of this might look different than it is at this moment?
What the last 4 years have taught us is that to show that the oil market is very adaptable. It adapts to all the changes and policies. When we saw first with COVID and then in Russia, that the oil finds its way to market, is obviously having impact on prices, but the oil tends to flow to customers. Of course, any of these policies or measures may lead to less optimal trade routes that increase cost, both for shipping and in terms of time to get the oil to the market, which also have implications for energy security. But what we do find is that the oil tends to shift. So if there's tariffs on Canadian and Mexican oil, for instance, it might have impact on prices, but we also see that the suppliers find new customers, perhaps in other parts of the world, if possible.
To a really fascinating report this morning. Thanks for spending the time with us. That is Toril Bersoni of the IEA. A quick check on your commodity markets this morning. It has been very volatile for oil. At one point over the past week, we saw oil trading at a 3-year low. Then it gets the biggest surge yesterday in 2 weeks. Brent crude, little change this morning at just under $71 a barrel. NYMEX crude at $67.56. Coming up, the new face of Intel, chips veteran Lip Bhutan plans to bring the company back to its former glory days. Can he achieve it? We're going to discuss next on your Bloomberg Brief.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Let's take a look at the front pages this morning and what's making headlines. First, the New York Times has this on their front page, that the EPA is targeting environmental regulations. That includes limits on pollution from tailpipes and smokestacks and protection for wetlands. The EPA Administrator Lee Zeldin said that his agency's mission is to, quote, lower the cost of buying a car, heating a home, and running a business. Next up, we have this on the Bloomberg, that the UK and France are working to strengthen Ukraine's negotiating position as President Trump pushes to settle its war with Russia. European defense ministers are discussing ways to provide security guarantees for Ukraine, including a reassurance force with troops, aircraft, and naval vessels. The plan is, presents that to Trump, hoping to persuade him to commit to U.S. security guarantees. The Wall Street Journal leads with this on their front page, that Intel has named a new CEO. The announcement came yesterday that Lip Bhutan will be taking over. He's a semiconductor veteran and the former head of Cadence Design Systems, and he will assume the role on March 18th. For more on this story, let's get over to Bloomberg's Tom McKenzie, who leads our tech coverage. Tom, what is the task ahead of time?
It's a monumental task, isn't it, for Lip Bhutan, who is taking over, as you said, in March from Intel, given all the challenges of this business, given the challenge around trying to compete with NVIDIA, given the debt load, given the fact that they have seen their earnings plummet. For now, as you've seen, the market reaction pretty positive in the context, of course, of an Intel stock that is down about 50% in the last 12 months. But this is someone with deep experience at Intel, formerly a board member. He will rejoin the board, as well as taking on the CEO role, of course. Former head of Cadence as well, the software and design company, and will bring that experience to bear. He says this will be a challenging job, but he is committed. Every fiber in his being suggests and tells him he can turn Intel around. This is still a company that's turning around revenues of around $50 billion a year annually. It is still in about 70% of personal computers worldwide in terms of their chips, but the challenges are monumental. Also suggesting that the foundries business that they've spent so much capex on building out in the US, that will continue. Pat Gelsinger, big part of his plan, of course, before he was ousted, presumably for not doing enough to turn this company around. But this new CEO comes with the experience, comes with the ambition, but my goodness, the challenges for Intel are huge going forward.
Considering they're sticking with that foundry business, Tom, does it suggest that there isn't a big strategy pivot, or is it just too early to tell?
I think one factor to watch certainly is what's going to happen with the CHIPS Act. And you've seen President Trump suggesting and calling, in fact, for senators and for House Republicans to rip up the CHIPS Act. And Intel has been a key beneficiary of the funding that has come through from that. So that's one to watch. In terms of the clearer strategy from Lip Bhutan, it's early days. He sent out a memo. Bloomberg got access to that memo. But you're absolutely right. The next earnings call, that is where the scrutiny is going to be. To what extent are they going to shift the focus? What is the clear strategy? Are they going to spin off more parts of the business? We know that there have been some waiting in the wings to snap up parts of the Intel business. Is he going to have a cleaner focus on the core parts of this business? And what are they going to do in terms of those AI accelerators? What is the plan there in terms of the catch-up, given the gulf that exists now between Intel and its propositions on AI versus NVIDIA?
Tom, thank you so much. That is Bloomberg's Tom McKenzie. And as you can see there, shares of Intel are up in the pre-market trade. Just worth pointing out that we have gotten some upgrades for them. Bank of America upgrading their call on Intel on the new CEO. So there is some enthusiasm, as Tom mentions. We'll see what they say in terms of strategy on their earnings call. It's been a rough ride for tech, but we are seeing a rebound more generally. Okay, coming up on the show, the tech bros are lying to you. We're going to look at that sell-off in tech and what it means for the wider industry. We're going to be catching up with BCA's Marco Papik as policy uncertainty keeps tech investors on edge. He's going to be joining the show next, your Thursday morning, your Bloomberg Brief.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Bloomberg brings you breaking news 24 hours a day, powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A game of chicken. Senate Democratic leader Chuck Schumer says that the party will reject Republicans' funding bill. On shaky ground, concerns over a potential government shutdown drag futures lower after a volatile session. And Intel has a new CEO. The appointments of CHIPS veteran Lip-Bu Tan lift shares in the early trade. And we seem to be selling into the rallies versus buying into the dip. We are moving lower this morning, down 0.4% for your NASDAQ 100 futures. Despite the rally in Intel this morning, that's not helping the overall equity indexes. Your S&P down 0.2% after a rally yesterday that was paired despite the excitement over a CPI that maybe took stagflation concerns off of the map for now. Your Treasury session also struggled yesterday, notable considering we had that cooler CPI. We're little changed this morning. 3.98 on your 2-year yield, 4.31 on your 10-year yield. The U.S. equity market, though, continues to flirt with a correction, and tech has been particularly hard hit within that. The NASDAQ, 12% below its peak. The Mag 7, 18% below its peak. BCA's Marco Papich writing, no sector has profited more from fiscal profligacy and subsequent multiple expansion than the U.S. domiciled big tech. The bottom line is that U.S. big tech are effectively railroads and that tech bros are universally lying about their moats. Marco, I'm pleased to say, joins us now. He's chief strategist of BCA Research. Marco, punchy, very punchy. Yeah. Look, a lot of people would say the sell-off in tech is just because things got overvalued, things are coming back down to earth. Are you kind of pushing back against that idea, that it goes further and it's deeper than that?
Yes, I am. I'm basically saying that for the past 5 years, we've had a really extraordinary amount of fiscal profligacy. I mean, the deficits have expanded massively. The U.S., much more so than any other economy in the world, spent on fiscal 4 times more than Europe in particular, basically the same level of spending as World War II. And all that fiscal spending went into multiples, it went into earnings, and has benefited U.S. domiciled big tech the most. And so if we now have a shift towards less profligacy, I think that there will have to be a re-rating of U.S. assets in general, not just big tech, the dollar, other equities as well. But of course, big tech has run out the most, so it will be impacted the most.
Is this short-term or long-term? And part of the reason I ask this is because this is an administration who's been saying that the pain is short-term, but in the long term, it's a shift towards the private sector, that the private sector picks up where government spending ended. So can tech get back to where we were, just the end of that fiscal surplus, of the fiscal giving it to various tech companies or finding its way into tech companies earning, that ending is enough to completely re-rate tech?
I think I think it's really, really significant. And what you see over the last 6 weeks, the trading over the last 6 weeks, doesn't really make sense from the context of what we're focusing on. Tariffs, trade. Why is the dollar down as much as it is against the euro? Euro was supposed to be at parity. It's at 109. Why are European equities leading over the US? I think that's sending you a long-term signal that the market doesn't really care that much about trade and tariffs. It cares much more about fiscal matters, US versus Europe. And so I do think this shift is permanent. It doesn't mean that tech has to re-rate and collapse as it did in 2001. You know, NASDAQ was down 80% in 2001 recession. That doesn't have to happen. The issue is that outperformance of non-US assets, I think, is permanent.
Does that mean that the leadership in the US in things like AI, that's also challenged at this point?
So that's a different part of my argument. It's not really about fiscal matters. It's more, I do think DeepSeek really mattered. And I think it matters because effectively what the DeepSeek phenomenon tells us is that you can have innovation in the AI space outside of big tech. I think that's fundamentally. Big tech will continue to provide the infrastructure. It will continue to have cash flow and earnings because it's building the rails upon which the AI revolution will run. But it will not have a monopoly over the productization of AI or innovation. And so yes, other sectors could actually benefit more. Healthcare, financials, industrials. And that calls for two things: rotation out of big tech inside the US, but also because other equity markets are less leveraged to tech, also from a global asset allocation, rotation out of the US in general.
I say that there's something ironic about this in the fact that you had all those tech CEOs lining up behind President Trump at the inauguration, and that this is the outcome that you're speaking of. But I wonder if them also getting more political, let's call it that, is also an issue for them, where you have China targeting different tech companies in the US, pulling back on approving Tesla's self-driving capabilities. Europe, basically their strongest suit is their ability to regulate in the single market. Is tech's turn political now a big weakness for them, especially as a trade war heats up?
You know, I didn't think of it that way, Danny, but I think it's certainly one of those things that maybe marks the top, if you will. And we do have the old adage, buy the rumors, sell the news. And I think one other way you can look at it is, you know, you have an America First president, but you may have America Last performance in relative terms in equity indices. And I think that's what the last 6 weeks have told us.
Well, one thing that a lot of people point to is that it's the uncertainty, the thing that's causing the sell-off. You've had Trump having his business roundtable meeting with leaders. One of those people was David Solomon at Goldman Sachs. He did speak to Fox yesterday, and I just want to quickly play some of the sound of what he said.
The more we can have certainty on the policy agenda as we move forward, the better that's going to support capital investment and growth.
So before he said that, Marco, he also said he wasn't opposed to the tariffs. It could be a good policy. He just wants certainty. Is certainty enough, or is it the policy itself that's a problem?
I think that certainty is enough, so far as the policy is not too extreme. And I think that too many people, especially here, you know, I've been meeting with a lot of investors in New York over the last couple of days. Everyone's asking the same question: what is President Trump's preference? I think the answer is nobody knows. I think he himself doesn't yet know. I think he's feeling his way through material constraints. And as he does that, there'll be uncertainty. And once the market, once the economy shows him the limits of his preferences, that's when things are going to get better.
Can you just talk about what would that look like? The economy showing the limits.
I think recession probability going up is obviously one of the limits. I don't buy the view that, you know, President Trump is unconstrained by recession, that he's in his second term, that he can't get reelected. I think that the reality is political capital is a very strange concept. It's a qualitative, mushy concept, but we can measure it. Approval rating, congressional approval rating for Republicans, upcoming midterm elections, all sorts of things can matter. And a lot of allies might start jumping ship if that political capital starts being drained, however you measure it. And so I do think that approval rating, recession risks, equity market drawdowns all still matter to any policymaker, and President Trump is no different on that front.
So just be clear, there is this sort of put, but it just looks a lot deeper and a lot more severe than where we are at this current level.
I think so. I think it is deeper than the current level. But the other thing that I would also point out, I mean, Solomon is talking about uncertainty.
Right.
Uncertainty is far greater to non-US markets. U.S. is an insulated, domestically oriented, consumption is 70% of GDP. Exports are very, very single digit. So my, again, challenge to the investment community is take a look at market action. Trade war was supposed to be very positive for the US dollar. It was clearly not supposed to be negative for big tech, which should be insulated from it. And yet here we are. And I think that we shouldn't ignore market signals. Market is telling us that there's a very deep rotation going on outside of the US, and I think it's sustainable on a 5-year trajectory.
Marco, this has been so fascinating. We could do this all day. Unfortunately, I'm out of time, though. Marco, so great to see you. Thank you for coming in this morning. That is Marco Papich of BCA Research, and you are watching Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democrat leader Chuck Schumer saying that his party plans to block the Senate Republican spending bill, leaving the door open to a government shutdown this weekend. For more, we're joined by Bloomberg government reporter Kate Ackley in Washington. Kate, how likely does a shutdown seem at this point?
Well, it's more likely than it was 24 hours ago. We saw the rhetoric kind of shift over the day yesterday with Senator Schumer's comments that you just played, and we have another pivotal day teed up on Capitol Hill today and in Washington. They may come to a deal. They've still got a couple of days, but it's, keep in mind that the House voted on this measure earlier this week and then left town. So the House of Representatives is not in session right now, and they would have to come back if there was going to be a different bill that passes Congress.
How do we understand the Democratic strategy here, Kate? Because The larger political narrative has been this one of uncertainty, concerns about a recession starting to bubble up. Yet they're kind of taking attention away by making moves that get us closer to a government shutdown. So what has been the word for Democrats and why they would pursue this strategy?
Well, there are several things going on, obviously, all at once. I think you're seeing Democrats test out their messaging strategy. They are still working out their own strategy, Senate Democrats. Keep in mind that they're hearing from a sort of broad range of constituencies. And if you want to take a look at the local level, D.C., this stopgap measure that passed the House this week would essentially tie up $1.1 billion of local DC budget funding. And so we've seen DC Mayor Muriel Bowser, members of the DC Council, go up to Capitol Hill this week and say, you know, this stopgap measure that passed the House is really bad news for the DC, the local DC budget, the police, the schools, and the city services. And, you know, I'm a DC resident, so I have seen a bit of a groundswell over really the last 24, 48 hours of people urging their, you know, friends and family who have senators across the country to put the pressure on their senators to, you know, change this, fix this, pass a different measure that would not limit DC's spending authority for the local resources.
And D.C. already under pressure with the cuts being made to DOGE. It feels like a vibe shift that's really undergoing there. But Kate, I thought this was interesting. The FT has a story this morning looking at Treasury data saying that U.S. federal spending has risen to a record $603 billion that month, and that there was only a handful of departments that registered drops in spending on any form. How have we seen the impact of DOGE thus far, and what's to come, Kate? Because at the moment, the data itself on a headline basis doesn't show too large of an impact.
Well, we have a few things to keep in mind. Number one, the uncertainty. So you have a lot of federal workers who maybe are still employed, who've got their resumes ready, and they're sending them out, and they're looking for jobs, not just in the Washington, D.C. region, but across the country, you know, people looking to make big life moves. So stay tuned on that. And the other thing, we have a couple of deadlines coming up where, yes, we've seen the DOGE cuts, which I think people have sort of likened to more of a sledgehammer approach, if you will, and some of those have been peeled back. But now you have agencies under a deadline. One is today, phase one, to kind of list their reductions in force, who they're going to let go. And then a month from now, there's another deadline. So you see sort of these staggered deadlines where agencies and federal departments themselves are going to be recommending, here's who we think should be cut. So you have a number of federal employees potentially on the chopping block over the coming months.
And just to point out to our audience, we will be getting initial jobless claims in under 3 hours' time. So we'll see if any of the beginnings of that have started to appear. Kate, thank you so much. Bloomberg Government's Kate Ackley. And don't miss our upcoming interview. The surveillance team will be speaking with U.S. Commerce Secretary Howard Lutnick at 8 a.m. Eastern. Let's turn now to banks. Deutsche Bank this morning announced that it's boosting its bonus pool to a decade high. That's after the lender saw a surge in deals and trading last year. For more, we're joined by Bloomberg's managing editor for EMEA Finance, Jenny Serrain. Jenny, it's remarkable the difference in fortunes between Deutsche Bank and some of the American banks. Deutsche Bank up some 30% this year. The likes of JP Morgan have moved lower by 4%. What accounts for the change in fortune for the likes of Deutsche Bank?
I think there's a couple of things going on at Deutsche Bank. So, you know, they're really known as like a fixed income powerhouse, a debt capital markets powerhouse. Those are products that did really well, even throughout kind of all of the craziness of the U.S. election, the changing in central bank stances last year. So those are two products that did really well. And then I do think just more broadly, a lot of these banks are having to think about, you know, ahead of another term with Trump, where his last term obviously brought lots of deal-making activity, lots of opportunities to to kind of soak up trading activity. They want to make sure that their desks are properly staffed and that they've, paid them enough to keep them around for another year so that they can kind of benefit from all of the activity that Trump is supposed to bring. So I think you had a good year last year, just where they were positioned and what they're known for. But really, this is also a sign for kind of what they're expecting next year and what they want to be prepared for.
So take that macro context and put it into the micro of HSBC, because they have been going under this restructuring. A Bloomberg scoop this morning that some investment bankers are being put on short-term retention agreements. What kind of overhaul are they targeting, Jenny?
Yeah, so on the other side of the fence, you're absolutely right. We have HSBC, which has been doing a broad restructuring. So it's not just within their investment bank, but within their investment bank, they did decide, we've always been known as, again, a debt capital markets powerhouse and really better on the debt side. We haven't been able to get the traction that we wanted on equities or M&A, and so they decided that they're going to get out of those businesses in a lot of key markets around the world. And so now you kind of see them sort of in the nuts and bolts part of that process. And so, telling these bankers that are working on deals that they had already signed up before making this decision, we're going to need to put you on these short-term contracts, and sort of working out exactly how their workforce is going to be phased out on these different projects. And so it's sort of in the same vein as Deutsche Bank. You see these banks, picking their spots, knowing where they're good, and in HSBC's case saying, you know what, we've got to call it quits when we know it's time to go.
Jenny, we appreciate the update. That's Bloomberg's Jenny Serene. Now, from banks to tech, shares of Intel, let's get a check on how those are faring in the pre-market session, because they've been getting a boost, up nearly 10%. They announced that they've appointed chip veteran Lip-Bu Tan as its new CEO to restore its position, they hope, in the semiconductor industry. Joining us is Bloomberg's Tom McKenzie. Tom, what do we know about Tan?
Yeah, look, he's a 65-year-old with deep experience in terms of engineering around semiconductors. Also someone with a track record, Danny. I think this is important as a turnaround winner. He managed to do that with Cadence in terms of the software company there. He turned that business around, so that is in his favor as well. We've had analysts talking to Bloomberg News saying that they welcome this, hence the kind of upside you're seeing, at least for now, in this stock. But my goodness, this is a resuscitation attempt of a corporate amongst the most challenging that we're thinking about as you look across the US right now with Intel and its debt load and its challenge around not being able to produce an AI accelerated chip to catch up with NVIDIA. The foundries part of the business, the fact that they're spending billions of dollars building that out whilst notching up billions of dollars of losses when it comes to earnings. So it is a turnaround that is needed. He says he wants to rewire and remake Intel for the future. Lots of question marks still remain, of course, but for now at least, a little bit of relief on the surface. Pat Gelsinger, of course, was forced out. The board didn't think he'd done a good enough job in terms of turning us around. Lip-Bu Tan comes in, former board member of Intel. He will retake a board seat as well as company CEO, and we'll see. We'll be watching for the details and the commentary, of course, at the earnings when it comes through. He's taking his seat in March.
I was going to say, Tom, in terms of the timeline, how much patience will Tan get, given that the board did push out Gelsinger, given that some of the customers are maybe unhappy or confused or looking for some change when it comes to Intel and their own direction? Do we have a sense of when and how Tan will be laying out the future strategy of Intel?
The key question will be whether or not he will pursue the foundries part of the business, given the capex around that, whether that is the foundries in Israel, in Ireland, in Arizona, in Ohio. They benefited from some of the CHIPS Act funding, about $8 billion US. It is a hugely capex-intensive business. They want to be in a position, and this was part of the Pat Gelsinger strategy, to be able not just to manufacture their own chips, but to manufacture chips for their customers, to take on the likes of TSMC, a company, by the way, that is investing $100 billion US in the US alone. So that remains a key question as yet unresolved. Lip-Bu Tan has suggested in his memo that he wants to keep that strategy. The patience could wear thin. This is still a business that's churning over revenues of about $50 billion US a year. It is still providing chips to about 70% of PCs, but that is a market that is soft, flat, bottoming out. They want to be in AI accelerators, and they haven't managed to do that as well. So on those key questions, the foundries and what will they do in terms of AI accelerators seem to be two key questions that will be put to Tan, and the question marks, of course, over how much time he's going to have to turn things around. It's a juggernaut, and it's going to take time.
Tom, I want to wrap things up with a different tech story, and that is a Bloomberg scoop that the FTC will be moving ahead of an antitrust probe of Microsoft that the Biden administration put on in their waning days. There had been some hope that this would be an FTC that wouldn't pursue as aggressive antitrust policies as Biden. What signals do we gather from this?
Yeah, and that's the key point, isn't it? This is a key takeaway because the probe continues. It is a sprawling probe. Satya Nadella may have been there alongside other tech veterans and tech CEOs, of course, alongside President Trump. The expectation that with tech in the room with the president, that they might get an easier call and an easier set of officials in terms of the scrutiny and probing that they are facing. The signal from this suggests that isn't necessarily going to happen, that big tech and monopolistic behavior, alleged monopolistic behavior, is still a concern for these newly in place regulators at the FTC. They've already, what we know from Bloomberg reporting is they've been talking to customers, they've been talking to those parts of the ecosystem within Microsoft. They have to hand over, Microsoft has to hand over reams of data about its AI business, about data centers, about its relationship with OpenAI. This probe, these investigations can take years. They may not result in a case, but clearly it reminds us that scrutiny continues on big tech.
Tom, thank you so much. One of the best. We appreciate it, as always. Bloomberg's Tom McKenzie there. Coming up on the show, there's a deadline approaching for federal layoffs and restructuring plans. We also have another round of jobless claims. We're going to set up your trading day. Up next, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Get you set up for your trading day on this Thursday. U.S. PPI and jobless claims come out at 8:30 a.m. Eastern. Retail earnings will get Dollar General before the bell, Ulta Beauty after the market close. Plus, federal agencies have until today to submit plans to the Trump administration for large-scale layoffs. Let's quickly move through some stocks on the move. Adobe extending post-earnings losses. They gave a tepid outlook. American Eagle also to the downside, nearly 10% decline. They gave a weak forecast, also pointing out Wells Fargo just up 0.5%, but we we did get an upgrade from RBC, citing an attractive entry point. That is it for Bloomberg Brief. Surveillance will take things from here with an interview with the Commerce Secretary in about 2 hours' time.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We've got a deteriorating fiscal situation here, and slow economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, looking for some relative calm after snapping a two-day losing streak in yesterday's session. Equity futures struggling to build on those gains as Washington heads towards a government shutdown.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democratic leader Chuck Schumer pledging to block the Republican spending bill heading into a weekend deadline, teeing up a busy 24 hours in the nation's capital. Commerce Secretary Howard Lutnick set to meet with the Ontario Premier Doug Ford later on today, attempting to bring down the temperature with Canada.
When the biggest client, the biggest trading partner, the most important counterparty you have, who really, really matters to you, the first thing you do is show immeasurable respect. Say thank you.
You say thank you. Secretary Lutnick joining us a little bit later on this morning, 8 o'clock Eastern Time, 2 hours from now. That meeting, front and center.
The question of can they bring down the temperature, and is this still a drug war? Are we moving into the April 2nd question of actually the new tariff regime at a time when a lot of people are saying, just tell us what the ultimate goal is. Maybe this is a feature, not a bug, but a real question of when it starts to matter that confidence is getting affected.
Who should be saying thank you to who? Because the Chinese foreign ministry official came out in the last 24 hours saying exactly the same thing about the United States, that somehow the U.S. should be saying thank you to China.
That's definitely not going to happen anytime soon. And what China was talking about said they've been cracking down on the product, the particles that go into fentanyl. But I don't see that happening anytime soon. Even though there are reports, Jonathan, that maybe there is planning for a meeting between Trump and Xi in the spring and in the summer. When it comes to this meeting with Canada, what I will say is that what you heard from Canada yesterday is that Doug Ford met with Mark Carney. They said they're not backing down, and they will go dollar to dollar, tariff for tariff with the United States.
So they've put new tariffs on $21 billion of U.S. goods, and my question for Commerce Secretary Howard Lutnick later on this morning will be, does that change your approach to this meeting? Does this meeting even happen? What happens when this conversation starts? Is that the first thing you bring up?
What's the goal of this meeting? Is it to have them take off any potential tariffs? Is it sort of one ultimate goal when it comes to the drug war? Look, I think it's important for the market and for consumers to understand exactly what the off-ramps are at a time when we seem to have a never-ending ratcheting up of tensions. And you have to wonder if the response to even good news is tempered that much more in markets as a result of this ongoing turn that we just keep expecting.
So a great example of that, and I'm sure you're alluding to it, is CPI yesterday. CPI comes out, downside surprise. What do bonds do? Yields rise. They fell initially, and then they started to climb. The attention of this market is firmly elsewhere.
So there are a couple of different interpretations of this. On one level, you could just say the bond and stock markets are singing from two different hymnals. On one hand, the stocks are optimistic that the best case scenario will come out, and the bonds are the worriers that are sitting around saying, this is all looking a little scary to me. If you look at the actual components of CPI, the components that go into the core PCE, which is what the Fed looks at, weren't that much softer. So some people looking at the actual details, but on a larger sense, worries very much shifted to tariffs, very much worried to growth, and very much worried to the deficit, which alludes to the potential government shutdown.
The next data point we're looking for, 8:30 Eastern Time. We're looking for PPI and jobless claims. This deadline for a government shutdown. I ignore it, ignore it, ignore it, and all of a sudden, you've got to start paying attention. Are we paying attention now?
We're definitely paying attention, but you might be able to ignore it. There's really two paths here. One, it could be political posturing. They want to invoke cloture. Maybe they can do that if the Republicans say, we're going to give you a vote on an amendment. That would be political theater, according to Jake Sherman. The other scenario is the Democrats hold firm, and we are in a shutdown after midnight on Friday.
Big 24 hours coming up in the nation's capital. Big 60 minutes coming up on this program. We'll catch up with John Stolfus of Oppenheimer, staying bullish on equities. Ed Mills of Raymond James as Canada strikes back against Trump's tariffs. And Greg Dacko of EY on upside risk to inflation. We begin this hour with stocks struggling to build on yesterday's gains as growth worries linger on Wall Street. John Stolfus of Oppenheimer staying bullish, writing, we remain positive on equities. The broad rotation which began in the rally from the S&P 500 low on October 27, 2023 has repeatedly deflected volatility. John joins us now for more. John, good morning.
Good morning.
Good to see you, sir. Does the policy changes, does the policy uncertainty change your view at all?
No, it doesn't. In fact, we would say, if anything, the policy uncertainty takes us to say, well, this is just about what you would expect. This is something, it's Monty Python used to say, and now for something completely different, if you consider the difference between the prior administration and this administration. We can't help but think, it's very natural. The prospect of tariff wars that could last is very concerning, okay, to business, to the consumer, and to governments alike on all borders. But we can't help but think that this is a process. This is the first president, and by the way, I'm not an apologist for the Trump administration, nor was I for the Biden administration. This is politically agnostic. It's a business person talking. When we look at it, for 80 years now, the U.S. has, in effect, had a very lax policy towards dealing with tariffs against our products. For decades, we have now exported our production, and the result of that is the rest of the world are the producers and we're the consumers. And without us, those other countries would suffer significantly. They have overcapacity in Asia, in Europe. They have overcapacity in Latin America. This is, for years, we have been building up, the world has been building up capacity to export to the U.S.
We can park the politics. I think you just have to focus on the policy and the objectives. And the objective is pretty clear, given everything you've said. Rebalance the U.S. economy, rebalance the global economy for that matter, and accept, in their own words, some disruption, a detox. What does that mean for markets?
Well, I think what it means is we have right now, we're going to be affected very much by an increase in volatility. That's quite natural. We think the way to weather it is with prudent diversification that meets the needs, objectives, and the tolerance to volatility for an investor or an institution's mandate. But it's not something that is indigestible. If anything, it's something that has to be digested at this point, because it's the first time we've ever seen an administration not kick the can down the road in terms of the cost of government versus services actually rendered, the tariff regimes around the world, and could actually, once people can meet at a table and cooler heads prevail, I think work out pretty well. The initial part, there's a lot of political jostling. You know, everybody is working to get their constituency to say, stand up for us, and whichever side it is. But once you get over that human lack of ability to get to down to brass tacks quickly, once you get to it, I think we get to a much better situation in a re-globalization, which should be good for both developed and emerging markets.
To be clear, I think a lot of people would agree with you, and a lot of people in the business community would agree with you as well, particularly in the United States, who have alluded to exactly what you're talking about. The issue is the near-term volatility of headlines and the path to get there, some of the negotiation tactics that are making people concerned about how long it might take to actually get to that place. You say that you need to right-size expectations for how certain assets will respond to volatility. Does that basically mean that you think that they should lower their expectations for a whole host of different assets?
We would say, it being realistic, it's like near-term lower expectations, and understand, for example, the sell-off that we'd seen in the financial stocks, for example, let alone what we saw in technology. Well, they had a phenomenal run last year, so a good place for a haircut or a trim or even a correction would be amongst those two sectors and others. So just live with it rather than dump and run. You stay with it, you're diversified, you know what you own, know why you own it, and have right-sized expectations. And like us, you might be pleasantly surprised over the course of a 40-year career.
Well, when you talk about diversification, it's taken on a different meaning over time.
Yes.
There was a question around bonds diversified. There was a question around whether gold was the ultimate diversifier. There was a question with geographies versus sectors. How has your understanding of what it means to be diversified changed in an era where there are some pretty seismic changes going on from the policy perspective?
I would say diversification today, the approach should be very much like one that is parallel to the one in fixed income, which is considered duration. Here it would be the duration of the need. In other words, are your objectives long-term for retirement? Are you a retiree who is a relatively young retiree? How long are you going to need to be exposed to equities to have, based on history, have a greater ability to keep your standard of living? And so we are really at a point now where, you know, the old days when the private investor would appear, they were usually the retail investor. It was cocktail party stocks that they would talk. Now today, people invest for need because they recognize the fact that things like Social Security will likely not be anywhere near the benefit percentage-wise what it once was for their parents or their grandparents.
When we have this policy uncertainty, though, and we see that bleed into the markets, we see pullbacks, are you advocating people buy more?
Yeah, we actually are advocating dollar cost averaging. We don't say buy the dips, but we say buy the babies that get tossed out with the bathwater. The type of volatility that we are seeing now We have seen parallels to it in the great financial crisis, in COVID. Remember when COVID struck? I'll never forget, in April of what was it? April of 2020, wasn't it? Yeah, April of 2020, you had some of the smartest people in the world on shows saying it could be decades before they find a cure for this deadly virus.
Is that how they all sounded?
Well, it did to me, you know, and then we had, at that time, Trump was in the White House, and he said something to the effect of, well, we could have, you know, in his own inimitable voice, I'm not going to get to imitate the president, but he said, we could get drugs in a warp speed, and within a short period, relatively speaking, we had it. We don't wear masks today.
We had a lot of fear, though, cross-asset, and you saw that in credit, too.
Yes.
You could make the argument this morning you don't see that in credit at the moment. I think it was Jonathan Krinsky yesterday of BTIG who said that market bottoms need doubt. Do you think there is sufficient doubt that you can buy this morning?
You know, I wouldn't back up the truck, but I don't have any problem with layering in at this point.
And where would you layer in? Because there are a lot of babies, to use your words, that have been tossed out. Tesla, Palantir, Nvidia, the list goes on and on. Even Apple was struggling yesterday. Where are those babies?
Well, okay, as you know, because I manage money at Oppenheimer, they don't let me pitch
just
stocks,
describe
but
the
I give you the
opportunity.
sectors.
Sure, please.
Information technology, communication services, which has the search engines, the streamers, and the social media. I would also be looking at a consumer discretionary. The American shopper persists at shopping, even though now at discount, private label perhaps, but still shopping. Businesses are still doing what they're doing, and so we would look at financials and the industrials. You know, the industrials are so well positioned to take us into the next chapter of AI, industrial equipment that needs to be advanced to create all kinds of developments in terms, whether it's the electric grid, whether it's medicine, whether it's just in finance, what it can do to help us get through all the data that gets produced.
What about the travel names, John? Given the downgrades we've seen from the airlines earlier this week, what about the travel names?
You know, I would have to say that's not surprising. Airlines have been remarkably strong for a fairly long period of time. You know, we've never been big fans of airlines, whether we're at the airport or whether we're considering what to buy, only because of the nature of that business and the ability of the traveler to suddenly stop traveling abruptly or keep traveling much longer, the ability to charge ridiculously high fares. You know, still, I haven't been to Europe in years now.
20 points of me.
COVID.
It's getting expensive. It's Lisa's fault.
But my point is what happens is we need to see more competition come in, and that's going to hurt earnings.
What's the old joke? The fastest way to become a millionaire? Start with $1 billion, buy an airline, something like that.
There you go. And I think Buffett learned that years ago at one point. I can't think of it. Was it U.S. Air, or there was some airline that Buffett took a position and he limped away from it, which he rarely limps away from.
A lot of people have been burnt over the decades, that's for sure. John, it's good to see you. As always, appreciate it. John Stolfus there of Oppenheimer. This just drops from Torsten Slok over at Apollo. He calls it a wait-and-see economy, and he says that in a wait-and-see economy, eventually it leads to a slowdown of the hard data. Markets should prepare for that scenario. So just an alternative view compared to what we just heard from John, just dropping from the team over at Apollo.
Yeah, and we'd heard about small business confidence dropping to a 4-month low and some of the internals of that. Torsten points out that those small businesses account for about 80% of total U.S. employment. So you will see it if that lack of confidence and lack of action does continue.
Look out for jobless claims later this morning as well at 8:30 Eastern Time, a few hours from now. Equity futures just about unchanged on the S&P 500 with an update on stories elsewhere. Let's get your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. U.S. Senate Democratic leader Chuck Schumer says his party will block a Republican spending bill to avert a government shutdown on Saturday. Schumer urged the GOP to accept a Democratic plan to provide a month of interim funding instead. Let's get a check on the shares of Intel, up 11.5% in the pre-market. The company named Lip-Bu Tan as its new CEO. The former board member and semiconductor veteran has a large task ahead of him. Restore the fortunes of a pioneer chip maker that's become an industry laggard, struggling with market share losses and manufacturing setbacks. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station. The new crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. You know my position on this story. Should be the biggest story in the nation.
We still have 2 people stuck in space.
How many people actually know their name, though? Butch and Sudi.
Yeah.
How many people actually know
I know,
that?
but can you say their last names?
No, I can't.
Yeah, I can't.
No, they should be household names.
I know, it's true. And what are they doing in there? I want to know. How are they spending their time for 9 months up in space?
With great difficulty, I imagine, given they were meant to go out there for a few weeks. Got to figure this out. Up next on the program, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
To my European colleagues, we will work together to put pressure to end these tariffs against you too.
So it's a team effort now. Ed Mills of Raymond James joins us next to break it down. From New York City this morning, good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Snapping a 2-day losing streak in yesterday's session this morning, just about unchanged on the S&P 500. Over in the bond market, yields up a single basis point, the 10-year 432.39. Later this morning, PPI data and jobless claims as well. 2 data points to look for at 8:30 Eastern time. Under surveillance this morning, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
This is going to be a day-to-day fight. To my European colleagues, we will work together to put pressure to end these tariffs against you too.
A united front. Here's the latest. Canada striking back against the United States with new levies taking effect today. Canadian officials set to meet with Commerce Secretary Howard Lutnick as they seek an off-ramp to the trade war. Let's get to the team coverage with Bloomberg's Tyler Kendall in Washington. Divya Balji in Toronto. Divya, I want to come to you first and just try and understand the position of the Canadians as they get set to sit down with the Commerce Secretary. What's their approach to this meeting?
Yeah, I mean, I think it is quite clear that they would love to bring down the temperature. I mean, even Lutnick has said that. You know, I think if it's possible to completely not have these tariffs in place, you know, I think they would really love to do that. But I think there is also a response or an approach here where if the U.S. is going to do this, then we are going to fight back. And I think that's how they're looking at it. When you look at the way they've done things so far, you know, the initial tariffs that took place at the start of March, you know, then they came back and retaliated. Then again, now with steel and aluminum, there is still a whole bunch of goods that they have said they plan on putting tariffs on in a few weeks, leading down this path if we have to go through it. So if they can bring down the temperature, they will, but if they can't, they're going to go ahead and continue along this ride, essentially.
Tyler, when it comes to the U.S. response, yesterday the president says there's no inconsistency when it comes to his tariff regime. He says he has the right to adjust, and he says he's calling it flexibility. Will the Americans be flexible today?
Right, and Anne-Marie, also important to note that Prime Minister-elect Mark Carney said yesterday that he's ready to have a call with President Trump, but only if the White House respects Canada's sovereignty, as we start to hear senior administration officials this week again repeat the claim that they'd like to see Canada the 51st state, something Canadian officials have said is very disrespectful. But we haven't gotten really any indications from the White House that a call is being scheduled or put on the books, which leads us to believe that this really is just the first step here to try to get these members of Canada's ministry, including the finance and the industry minister here in Washington today. And President Trump, you said it there. He said that there will be flexibility. That's why he's moving with these different targets. But he also said that there will be very little flexibility once those April 2nd reciprocal tariffs come around.
Tyler Kendall alongside Divya Bauchi. To the two of you, thank you. Big meeting coming up later on in the nation's capital. Joining us now to discuss is Ed Mills of Raymond James. Ed, welcome to the program. I think we've all been slightly confused around the objectives. Let's talk about what the ultimate objective actually is. It started out by being about the northern border, fentanyl, immigration, and then it became about dairy access all over again, and then also in between something about becoming a 51st state. What is the overall objective here?
So I think what we're seeing here
I think we've lost that connection with Ed Mills of Raymond James just as it started. But I think that's the conversation we've got to have with the Commerce Secretary later on this morning, who, by the way, if you are just tuning in, joins us in about 1 hour and 40 minutes' time. That's going to be one of the early questions. What is the objective? What does the President want? What are the demands for the Canadians that you're set to articulate later on today?
How much really is this still about drugs and not necessarily about a whole host of other issues that are supposed to be unveiled on April 2nd? And right now, people are trying to understand the tea leaves so that they can get in and make plans at a time where they've got ships on the sea coming in and they don't know how many tariffs they're going to ultimately be paying on that.
I look at what the president said yesterday when he said, I'm not going to be inflexible. I can change my position. I have a right to adjust, except Tyler put a great point at the end. Until April 2nd, when you get this reciprocal tariffs. So the conversations today, are they about potentially what's to come on April 2nd? Also, are they about just front-loading, bringing forward the USMCA renegotiation talks? Are they trying to get ahead of that now so the administration can focus on other things next year?
This was not on my bingo card coming into 2025. I didn't think we'd be spending this much time trying to work out the trade situation with the Canadians. I think we all had a good feeling that it was probably going to be Mexico because of what was happening at the southern border, but also how the Chinese had been using Mexico as a back channel to get around some of the tariffs that they'd been put on the country over the last several years. But Canada really wasn't top of the list for anybody.
And it wasn't top of the list that suddenly Donald Trump would be responding to sort of a tit for tat with respect to the Ontario mayor. The idea that Howard Lutnick on a recent interview came out and said that the 50% was trying to get a guy's attention in Ontario. So there's this difficulty in understanding strategy versus goal at a time when you're seeing that start to bleed into confidence. That said, a lot of people agree that there is still time to give confidence to businesses that haven't materially laid people off or made big decisions. But that clock is ticking.
When it comes to strategy, it's interesting. Howard Lutnick in this previous interview was talking about the fact that they like the way Mexico has gone about it. They said the Mexican president has been very classy, getting on the phones, doing the right things. They haven't seen that from Canada. How much is this about what he calls just Canada saying thank you? Maybe Mexico behind the scenes said, thank you.
Well, they've been going through a leadership contest, so they've got their own problems domestically in Canada right now. I think another curiosity for us all, perhaps not for Commerce Secretary Howard Lutnick later, is where this leaves the Conservative leader in Canada, Pierre Poilievre, who had a lead of something like 20 points over the Liberal Party going into this trade mess of the last 4, 5, 6 weeks. They have really turned things around in Canada off the back of this trade story, and they being the Liberal Party.
Which suddenly now Mark Carney is in the lead and is likely to take over. A question more globally about how much this is the case. We're seeing this in Germany. We're seeing this more broadly in Europe. Some of the sort of old school establishment coming to the fore as the main voices to try to get unity for the regions.
Up next on the programme, we'll talk about the economic data later on this morning. PPI data after getting a softer read on CPI, and then later as well, jobless claims in America. Will we see any weakness start to creep into the labour market? We'll get the view of Greg Deco of EY from New York City. This is Bloomberg TV.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures on the S&P 500 just about turning positive this morning by not even 0.1%. Yesterday snapping a two-day slide on the S&P 500. There's nothing too convincing about any of this, though, at the moment. On the Nasdaq 100, just about unchanged. In the bond market, so yesterday, CPI comes out. Downside surprise. Initially, yields fall back, and then they start to climb again. They're up again this morning on a 10-year by 2 basis points, 432.96. There is a takeout there. I think a lot of economists concluding that when we go into the Federal Reserve meeting next week, yes, on the margin, a softer CPI brings some comfort, but the attention the forward-looking attention is firmly elsewhere.
Especially because some of the components that led to CPI softening are what we already know. American Airlines, Delta, United, airplane tickets have been coming down, travel costs have been coming down. At the same time, other parts of that report really were sticky. And so it leaves today's PPI as very much front and center about whether the Fed actually is looking at a better than expected inflation print on their core PCE or not. And that actually is going to be important.
I wonder if we could perhaps go one step further and suggest just this question: whether events elsewhere, Germany specifically, limit the ability of yields to drop too much in the United States. I just wonder if that puts a floor under the Treasury market at the moment, because what you're seeing in Germany is so profound. The regime shift is so large that it's dragging yields higher worldwide.
We've asked people this question, and everyone has a different answer. Some people say, yeah, absolutely. You have more debt sloshing around in the world and more demand to use your dollars. Well, guess what? You're going to see higher yields. And other people say it might just suck assets from everywhere else. And remember, those money market accounts, they've got to go somewhere. So, you know, there are a lot of counter discussions around this. Either way, the bond market is picking up something that maybe the stock market just isn't.
It sounded like a bullish Southside strategist for about 2 seconds.
I can pretend.
Yeah, that money's got to go somewhere with that money on the sidelines.
How much we hear that all the time?
All the time,
check out the money market accounts. There are $50 trillion out there on the sidelines.
It's amazing. It'll buy all the stocks.
Yeah.
Equities right now, just about positive on the S&P. I want to finish on foreign exchange. The euro looks like this. The dollar, DXY, over the last few days, new lows for 2025. In and around those levels at the moment. Euro dollar 108.71, just in and around 109. On our radar this morning, President Donald Trump vowing to respond to the EU's countermeasures against his steel and aluminum tariffs. Canada also striking back, announcing 25% tariffs on $20 billion of U.S.-made products.
What I think is so interesting about this, and something we really should ask Secretary Lutnick, is Donald Trump yesterday said he will respond. Is the response going to come before April 2nd, when they say is going to be this, quote, big day with the reciprocal tariffs being announced? Or are we going to sit there and have 3 weeks of maybe some stability and calm and not this frenetic every single day policy change? The Canadian foreign minister said this is going to be a day in and day out fight, which is why this meeting today in Washington, D.C. between Lutnick and the Premier of Ontario and the Finance Minister of Canada is so important.
How much is this a style thing? Come in, say thank you. It would be our honor to be our first 51st state, but frankly, we just can't do it right now. But we really just love having you on our border. Thank you, and then the tariffs go away. I mean, really.
I'm not sure that's going to fly at home. Can you imagine if that actually happened today?
Well, I'm just saying, I mean, how much is this stylistic versus actually substantive? And that is something, concretely, that we don't have a sense of.
I do think some of it is style. You can even see that yesterday. Donald Trump was sitting down with the head of Ireland. Ireland has literally the biggest trade deficit out of all the European states, and yet Trump did needle him on it, but he wasn't very rude or bombastic to the individual, and they said, look, we still have a great relationship. So maybe part of it is a little bit of style.
You'll hear from the Commerce Secretary later on this morning on this program. That interview is about 90 minutes away. I want to get to the latest in Congress. The Senate Democratic leader, Chuck Schumer, saying his party will block a Republican spending bill to avert a government shutdown this weekend. Schumer urging the GOP to accept the Democrats' plan to provide funding through April 11th instead.
So he basically got up on the floor yesterday and said Republicans don't have the votes. Well, of course they don't have the votes because you need 60, they have 53. That's just the math. Two things can play out. One, they hold firm and we see a government shutdown and they try to pin this on the Republicans. Two, they say, we're going to give you the votes for a procedural moment to invoke cloture, but you have to give us in return a vote on an amendment, just so they have it on the books that they pushed for a different outcome, AKA political theater.
Democrats don't want to block this. I mean, ultimately, there are a lot of Democrats that don't want to end up with this on their head, that they caused the government, amid all the potential concerns around tariffs and some of the volatility. All of a sudden, if the Republicans can say to the Democrats, you're responsible for the government shutdown that now raises the question of downgrades to the U.S. credit rating, not a good look. So it's very difficult, and I have to wonder what exactly the discussions are like on Washington, D.C.
We've dealt with this stuff, unfortunately, a million times. I think market participants can deal with it. What they can't deal with, the fact we're talking about this means we're not talking about taxes. And that's the issue for a lot of investors right now. It just pushes that back and pushes it back. And we need to be talking about that up front right now. And we are talking about that down in Washington, D.C. The Commerce Secretary, Howard Lutnick, saying President Trump wants taxes for Americans making less than $150,000 a year to be zero tax. He also wants to have no taxes on tips either. So this is the big push coming from the president.
I feel like we're back to the campaign trail of Oprah Winfrey taxes. Everyone gets a tax cut. There's no tax on tips, no tax on Social Security, no tax on Medicaid. It's very difficult to see this when you have the budget deficit rising. But this is something Donald Trump did talk about. He said remove tax on citizens, replace it with tariffs. He talked about this on the campaign trail. This is something Peter Navarro would like to see, but it just does not seem feasible, especially when you look at the makeup of Congress and the fact that they want to bring the deficit down. It just doesn't make sense.
Representative Mike Crapo, Republican of Idaho, came out and said yesterday the price of this bill grows and is a bigger deal than everybody is focused on. Meanwhile, estimates are that it will add $5 trillion to the deficit over the next decade. So a question of how they can feasibly get this done and whether some of the cuts elsewhere really can offset this and then some to really quell some of the deficit concerns.
Margins are small. This is not going to be easy, that's for sure. Of course, we'll catch up with the Commerce Secretary on some of those comments a little bit later this morning, again at 8 a.m. Eastern Time. Let's turn to the economy. Traders counting down to PPI due out in less than 2 hours' time. Greg Dacko of EY writing the following. The risks to inflation are tilted to the upside. The combination of still elevated inflation and resilient labour market conditions will keep the Fed on hold at the March FOMC meeting. Greg joins us now for more. Greg, good morning.
Good morning.
What's the source of that inflation, that upside risk to inflation? Where does that concern come from?
Well, I think the first thing to note is that up until today, we still had disinflationary forces. So we're still on this momentum where inflation was moving lower. But we're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs that leads to higher import costs, higher producer prices, filtering out into consumers. One of the key elements that I'm going to be paying very close attention to in the PPI report this morning is final demand for trade services. That's a proxy for margins, and that's usually a good gauge as to how businesses are passing on the higher costs. Because I'm worried about one thing. Last time we were here, I was talking about PIA, preemptive inflation anxiety. That concept is essentially this notion that there's going to be a much faster pass-through in terms of inflationary dynamics from producers onto consumers in this round of tariffs.
There are two sides, though, of preemptive inflation anxiety. And one side is companies passing along those costs, and the other side is consumers pulling back in preparation for higher costs and just all around a more expensive lifestyle. We're seeing that in the travel sector. At what point will slower demand offset some of the increases that we're seeing in price pressure?
I think that's a second element, a second shock in terms of economic activity onto inflation. The first round effect is really to see higher inflationary pressures. And we're seeing that in terms of uncertainty, because what consumers are doing is essentially hoarding ahead of any potential price increases. What that does is put in and of itself upward pressure on the very goods that are short in supply. We're seeing that also from the business side that are preemptively ordering goods that are likely to be tariffs. We saw in the latest data that trade imports were very strong. That's likely an indication that businesses are front-running any potential tariffs. That strains supply chains, puts upward pressure on supply, and leads to higher inflation preemptively. So those pressures are materializing now and will likely do so over the coming months. Once we start to see demand destruction, we may start to see some offsetting effects, to your point, on inflation, but that's a second round effect.
You know, it's just so interesting to me that we hear this being discussed by central bankers around the world. Yesterday, we heard that from the Bank of Canada, or Tiff Macklem came out and said that this is a new crisis and there's pervasive uncertainty, and discussed the difficulty in being able to cut rates again more significantly because of some of these inflation pressures. Where do you expect central banks to place the emphasis as they face off with the worst kind of dual risk, which is both slowing growth and inflation?
It's a great question, because when the two dual mandates are in conflict, the employment mandate and the inflation mandate, it's very difficult for policymakers to react. And the Bank of Canada said it well yesterday. Central banks are not equipped to deal with trade shocks. That's the simple nature of monetary policy. We have an environment where there might be this increasing risks on both sides. Inflation may go higher and growth may be lower as a result of these trade tariffs. That's the stagflationary shock that is very difficult to deal with from a central banking perspective. I think the key area to focus on right now is inflation expectations. Because so long as inflation expectations are anchored, central banks can look through any inflationary pressure that may be considered as transitory. I know that's a bad word in this environment, but they may be able to do so. If inflation expectations become unanchored, then central bankers will have a difficult time not reacting to higher inflation.
Let's sit on that central banker's dilemma just for a moment, and the approach to it and how you communicate around it. So, to Lisa's point, the Bank of Canada has been blunt about it. I would suggest that the ECB President Christine Lagarde has been equally blunt about it. Do you expect Chairman Powell to be as blunt next week in that news conference?
No, I think Fed Chair Powell will have to tap dance around policy uncertainty and its cousin, market volatility, because what we're seeing is essentially policy uncertainty weighing on business activity. The cost of waiting in this extremely volatile environment from a business perspective is very low. Businesses have no real reason to start acting, start investing in today's environment, nor have they reasons to start hiring. They're going to wait and see how policy develops. We're also seeing an environment where the first quarter GDP growth is likely to be lower, both on consumer spending that is softer and on imports front-running these tariffs. And then we have an environment where stock prices are under a tremendous degree of pressure. How will Powell react to all of those factors that are growth negative and stock market negative?
But what's different now than December was, well, December was really wait and see. Now it's showing up in data and in surveys.
Yes.
He can respond or should be able to respond to hard, cold data, no?
Yes, but the recent view from policymakers at the Fed, including Powell, is that the economy is just fine today the way it is. That may be a misread on the state of the economy. I would argue that the economy is softening, that the labor market is softening, that consumer spending is softening in this environment of high interest rates and high prices, and therefore there should be some accommodation. The risk, as you well know, is that in 3 months' time, in 6 months' time, we'll likely start to see much more of these inflationary pressures, and that will force policymakers to pivot. A very reactionary Fed is subject to rapid pivots, and that is unfortunately going to be the case, I think, in the coming months.
Front page of the Wall Street Journal this morning has data from convenience stores saying Americans are still coming up for gas, but they're not buying Newports, they're not buying Doritos, they're not buying Twinkies. Is that the first to crack when it comes to consumers, these extras you maybe get?
I think so. I think we're seeing consumers being very cautious with regards to service sector activity. You were talking about vacation plans. The latest conference board reading on vacation plans over the next 6 months fell to a 3-year low. We also saw, and perhaps this was a bit of an artificial effect, but some weakness in airfare in the latest month of CPI data. That may also be an indication of softening travel demand. We are seeing essentially this bifurcation in consumer spending. Lower income individuals are much more judicious with their outlays. Higher income individuals are still spending a little bit more freely. But let's not forget that a big driver of consumer spending at the higher end of the income spectrum is wealth and stock prices. So if we start to see that policy uncertainty filter into market volatility and put downward pressure on stock prices, that could be a risk for these higher income individuals, both on the confidence front and from a wealth effect.
We don't have to speculate too much about this. The airlines have told us it's happening. Delta came out first, American followed up, no one denied it. They said starting in mid-February, it started.
And it started as a result of uncertainty at businesses. They're seeing it among businesses that do business with the government, from the government, but it went beyond that. And they're saying they got the what? Parade of horribles. I love that from Delta CEO Ed Bastian.
Greg Dacker of EY. Greg, it's good to see you. Thank you, sir. Equities just turning positive on the S&P 500 with an update on stories elsewhere. Let's get to your Bloomberg brief with a parade of horribles with Danny Berger. Hey, Danny.
Thanks for that, John. President Trump's Middle East envoy, Steve Witkoff, is headed to Russia this week to present a 30-day ceasefire proposal to President Vladimir Putin. The U.S. reached the deal with Ukraine in talks in Saudi Arabia. Bloomberg reports that Putin will probably agree to the truce eventually, but will want his own concessions made first. The Federal Trade Commission is moving ahead with an antitrust probe of Microsoft that was opened in the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. Here's one away from the parade of horribles. Some good news from Deutsche Bank, increasing its bonus pool to the largest amount in a decade. The boost comes after a surge in deals and trading last year. Deutsche Bank awarded $2.7 billion in variable compensation to staff for their work last year. That's a 26% increase compared to the prior year. And that's your brief, John.
Hey, Danny, thank you. That stock having a wonderful run so far in 2025, that's for sure. More from Danny in about 30 minutes' time. Up next on the program, tit for tat, tariffs.
As you know, we're going to be doing reciprocal tariffs. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time. April 2nd is going to be a very big day for the United States of America.
We're anticipating that very big day. We'll catch up with Julian Mitchell of Barclays next.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. Can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
A few downgrades in the last few days. Over the past week, HSBC downgrading US equities to neutral, Citi doing the same thing. Goldman Sachs came out and cut their forecast on the S&P 500. We spoke to the biggest bull on the street early this hour, John Stolfus of Oppenheimer, with a price target north of 7K. He is still bullish. He says you want to layer in here. That's the bullish view. At the moment, equities, dare I say, and everything's relative, on the edge of snoozy over the last 24 hours. That could change.
Oh, you're going to jinx it.
That could change. Of course it could change.
Honestly, the fact that it's snoozy, though, can I just say, is actually news in and of itself. Because yesterday, everyone was getting really excited. The bounce is coming. We didn't see a decline. So there's a question of, can it continue? And if it doesn't, I think that's actually going to be really interesting.
I'm not trying to sell it. Just trying to say, as it is. Equity futures right now in the S&P, positive by close to 1/10%. Other surveillance this morning, tit for tat tariffs.
As you know, we're going to be doing reciprocal tariffs. So whatever they charge us, we're charging them. Nobody can complain about that. I don't know why people get upset about that because there's nothing more fair than that. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time as a country. I'll always have flexibility, but there will be very little flexibility once we start. April 2nd is going to be a very big day for the United States of America.
So here's the latest this morning. President Trump promising reciprocal tariffs against the European Union after it issued countermeasures against his 25% steel and aluminum levies. The measure weighing on the outlook for industrials. Julia Mitchell of Barclays writing, much of multi-industrials could see some negative impact on margins and perhaps profit for at least a quarter or two before offsets ramp up. Julian joins us now for more. Julian, welcome to the program. Let's get straight into it. That last line, when you think about offsets, what kind of offsets are available to them?
Hi, good morning. Yes, so I think there's a couple of main tools that CEOs will try and use in order to offset the effect of higher costs, whether it's direct raw materials or broader imported components. I think the first one, and they've all highlighted this as being a very well-developed muscle, if you like now, is push-up price. This sector, U.S. multi-industry companies, had about double-digit, low-teens price increases in 2022. That's the last time we had a spike in inflation of raw materials and components. Ending 2024, that price inflation for this sector had eased to around a low single-digit rate. I think all these companies are primed with their finger over the button to push up prices again very, very quickly in early April as needed. And they will expect that all their distributor and channel partners will follow suit as well. So that's the first very rapid response. I think beyond that, you may see some movement in sourcing of components and raw materials as well. But I would not expect probably wholesale changes to the manufacturing footprint of these companies. I think they're likely to use shorter-term measures, delay their own investments because of all the uncertainty, and then perhaps evaluate broader manufacturing footprint changes later on, perhaps next year.
Julian, I'd love to just develop that, this idea of how long before people start moving production back to the United States, which is the outset of, which is the goal, the stated goal of a lot of these tariffs. Are you saying that that won't happen in the vast majority of cases because they'll take a short-term view, expecting some of these tariffs to either change or be lifted at some point in the near future?
Yes, that's exactly right. Yes. I know for decades, and we saw a resumption of this in Mr. Trump's first term, and of course around the COVID supply chain issues, there's always this talk about U.S. onshoring, reshoring, that type of thing. I think it's extremely unlikely that most large manufacturing companies will do more manufacturing in the U.S. It's very expensive to do it. Labor's tight. Skilled labor for certain manufacturing jobs is even tighter. And so it's very difficult then for business owners to pursue that path if it's more difficult and more expensive. And I think one effect that you'll see from higher tariffs on imported goods will also be, of course, that domestically produced goods, the price of those will go up. So I would imagine you'll quickly see the cost delta between imported goods and domestically produced goods. That delta might be very wide on April 2nd, and then I would assume that within a month, it should be very narrow again.
Julian, how much is this giving a carte blanche to a lot of these companies to raise prices significantly, even beyond what some of the tariffs are, and raise revenue that way?
Yeah, so I think that they absolutely will look at a minimum to cover their dollar profits in terms of offsetting the higher costs. Many of them, I think, will also look to preserve percentage operating margins. And some of them, like we saw in 2022, when they were getting double-digit price increases, they could even see a big margin uplift. So I think it really depends on the company, their industry, the competitive landscape, how that feeds into pricing power. But absolutely, I think many companies will see this as some opportunity, perhaps, to even push operating margins up. And that's what happened 3 years ago.
Julian, what you're saying is completely different than what the administration is saying, which is that the stick approach of tariffs will bring manufacturing back to the United States. If you're saying that's not enough for companies, would a carrot like a 15% corporate tax rate do the trick?
It's possible, but look, we have a lot of experience of these types of carrot and stick moves from, the period of 2016 to 2020. You saw then a mix of corporate tax cuts, higher tariffs put on imported goods from China. So we've seen many similar measures before 7 or 8 years ago, and we did not see a pickup in U.S. onshoring or a pickup in U.S. manufacturing. If you look at recent years, things like purchasing managers' indices have been under pressure. Manufacturing employment in terms of jobs added in the U.S. has been under pressure. when you look at basic import-export data, an economy that's onshoring manufacturing should see a narrowing, one would think, of the trade deficit, because your imports start to move up. Your imports start to move down, your exports start to move up, the trade deficit would narrow. That's the opposite of what we've seen. And most recently, obviously, with the January trade data, you saw that opposite still playing out, very high imports and muted exports.
Hey, Julian, we've got to leave it there. Appreciate the update from you. Julian Mitchell there of Barclays on some of the industrials and how they handle these tariffs. The offsets, that's the word we're all interested in, how the costs will be distributed. Who's going to absorb these costs? Are they going to have to take it on margin? Can they pass it on? All those things we need to figure out over the next few months.
And ultimately, it just depends how much people want their products, right? If you are an iPhone, I was going to say an iPhone producer, but at the same time, Apple's kind of gotten hit on the head. I'm just thinking about what addictive devices in my home might end up being able to have some pricing power.
It also depends where you're producing that. Walmart goes to the Chinese and said, you're going to have to eat some of this. And they're saying, actually, we're not. It's on you.
This is not predictable at all. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Megan Horniman of Verdant's Capital Advisors, the former Trump White House trade official Katie Kalukowicz, the former New York Fed President Bill Dudley, and Dirk Willer of Citi. Look out for Dirk at the end of the next hour. Downgrading US equities recently and going into China. We'll get his thoughts in the next hour from New York City. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
We're still tactically quite cautious on equities overall, particularly, of course, in the US. This is the kind of time where you need to update your framework, your indicators pretty much on an hourly basis.
We're not seeing any signs of significant nervousness. There is a lot of demand for alternative assets.
The conditions are ripe for at least a relief rally.
If there's no recession, a market down 10% tends to have pretty positive returns in the 12-month forward.
Investors need to understand how much tolerance do they have for short-term mistakes?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with stocks just about steady on the S&P 500. Anywhere between unchanged to negative 0.1%. We'll see if that changes. On the Nasdaq 100, we're down about 0.2%. The main event later on this morning is the economic data at 8:30 Eastern Time. Both PPI, another read on inflation following a softer CPI yesterday, and jobless claims. Will the uncertainty around policy begin to bleed into the hard data and speak to some weakness in the labour market data? That data point coming up a little bit later. Coming up later, too, this conversation with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time, 60 minutes from now on Trade.
There's going to be a real question here of what kind of check the White House is looking at to understand just whether they still have some leeway to continue with this negotiating process. In other words, how much are they watching? If they're not watching Wall Street, if they're watching maybe Main Street, at what point do they take some of these indicators, these economic indicators, as a warning signal that they got to speed up this process?
Well, that's why PPI is going to be interesting. Paul Donovan of UBS talking about the fact that pricing power is important to determining how much of what he calls a trade tax passed along to the supply chain. So we'll get a little bit of that after we hear from Secretary Lutnick. And for him, most important today is going to be that meeting he's going to have in Washington, D.C. with the Premier of Ontario, the Canadian Finance Minister. One, the current tit for tat when it comes to the tariffs. Two, April 2nd reciprocal. Three, renegotiating USMCA.
There's a phrase we've heard repeatedly from a lot of companies, a lot of policymakers, a lot of business leaders: wait and see, wait and see. Torsten Slock of Apollo calling it the wait-and-see economy, and writing this morning. In a wait-and-see economy, it eventually leads to a slowdown in the hard data. Markets should prepare for that scenario. Are we prepared for that scenario?
The markets are starting to sniff that out. How much they can actually price that in is a matter of debate between the bond market and the stock market. And frankly, what the response mechanism from the Federal Reserve is another aspect of that. In that Torsten Slock note, he talked about the fact that small businesses account for 80% of the employment in the United States. They are signaling in the NFIB survey that their confidence is dropping, and they expect to have to raise prices at the same time that they're maybe remaining on hold and have a high level of uncertainty. This is a theme. At what point is it becoming sticky? And that, I think, is why the economic data becomes more important.
Small business confidence at a 4-month low early this week. Equity futures just about negative. We're down by not even 0.1%. Coming up this hour, we'll catch up with Megan Horniman at Verdant Capital Advisors as U.S. growth concerns grip Wall Street. The former Trump White House trade official Katie Kalukowicz on trade tensions, and Dirk Willer of Citi on why he's downgrading U.S. equities. We begin this hour with stocks just about steady. Megan Horniman of Verdant Capital Advisors looking for more weakness, writing, we remain concerned about economic growth in the first half of 25. The consumer is the biggest threat as debt and higher prices are straining balance sheets. We expect this valuation correction in equities to continue. Megan joins us now for more. Megan, welcome to the program. As you know, a feature of this economy post-pandemic has been the resilient consumer backed up by a strong and powerful balance sheet. What's changed?
I think this started to change last year. We saw that the COVID-related stimulus has really been wound down from the consumer's perspective, and they were borrowing using credit cards. We also saw some statistics recently where the largest amount of Americans are pulling from their 401k just to fund spending, and now we're seeing that hit a wall. The uncertainty has just risen too much from an economic perspective, and they're just stretched. Their delinquencies are rising as well. So we think this pullback in the consumer is healthy and warranted. And it's not too surprising to us given how much they've run really since the pandemic.
Jamie Dimon of JP Morgan said this recently: I don't think the average American consumer who wakes up in the morning and goes to work changes what they're doing because they're reading about tariffs. You've pointed out that this started in the last 12 months. How important has the policy shift, the policy uncertainty been to the changes you're seeing?
I think it's sped up that kind of consumer pullback. And I do think that the tariffs have impacted consumer confidence to a degree, but primarily because it's really created a lot of uncertainty around inflation expectations. And we've seen that in consumer data. You can look at the University of Michigan expectations for inflation. These have shot up significantly. So while consumers may not be following this tariff data, point to point every single day, just that threat of higher prices after they've already had to absorb higher prices for several years, that's combining with colliding with this really low consumer confidence.
When you look at all the data, what to you speaks the most in terms of volumes of what you really are looking for to see a slowdown in the consumer?
There's several things. Obviously, retail sales is a big thing, but we look also at some of these consumer confidence indicators. Historically, it may not have really happened so much in the past couple of years since the pandemic, but if you go back beyond the pandemic and just look at history, there's a tight correlation between weakness in consumer confidence and then how that correlates into future spending. And we've just seen confidence continue to deteriorate. We're looking at levels, if you go back to either the lead up to recessions or slowdowns in the economy, we're there from a confidence level. So we think this is going to correspond to some slowdown in spending the first half of this year.
Could this uncertainty push the U.S. into a recession?
We're walking a very fine line because we have seen that, you can see consumers kind of live in this feedback loop. So where it continues to be negative headline after negative headline, and then they just pull back spending, similar to how businesses do. Let's just wait and see. And the problem with that is the consumers make up 70% of U.S. GDP. So if the consumer pulls back, that does impact GDP.
So what's the defense trade here, Megan? Is it to buy bonds?
Well, not a couple weeks ago, no. And I think the defense right now, we did see yields come back down. They are now widening out a bit, but not really in the longer term part of the curve that warrants you that risk or rewards you for that risk you're taking from an inflation perspective and then from an issuance perspective, specifically here in the U.S. Instead, what we're looking at in our portfolios, and we came into this year, is make sure you have dry powder to put to work. Also, don't be afraid to invest in things that look like those valuations are rewarding you for that risk. It's okay to be a little ahead on this, but when you're looking at some of the areas of the equity market that are down close to bear market territory, like small and mid-cap stocks, if you can withstand short-term volatility and have a long-term time frame, then these areas you should start piecing away at.
There's a question about what we should be pricing in. And Julian Emanuel of Evercore ISI put out a report that I thought was really interesting, talking about how the market right now seems to be pricing in more of a stagflationary-like scenario, which could mean a 10% downside to equities. If there were truly to sniff out recession, it would be some 40% drawdown or something of that nature. Do you have a sense of what that looks like? Do you agree with that assessment?
I think that's a little bearish in our opinion. I think this is a short-term recalibration or reassessment of what we're looking at from an inflation standpoint, from an interest rate standpoint. Don't forget that investors have been looking for continuous Fed rate cuts. And I think what you're realizing now is the Fed can't come in and save the day like they have in the past. That Fed put is something we won't see. They don't have that flexibility. So I think you're seeing this kind of, from a valuation perspective, reassessing what we can expect from interest rate cuts, what we can expect from the earnings environment. And obviously the earnings environment right now is at risk because of the tariff, back and forth. But I think this is, anybody who came into this year not expecting volatility to pick up, I think came into this year very complacent. We did not. We knew that we've had the Trump administration before. We know the playbook. He's campaigned on this. We know he's a disruptor. He was coming in to disrupt markets. He's just doing this, I think, much quicker than people expected. So he's pulling a lot of this uncertainty into the first quarter of this year. I think as you get into the summer, a lot of this will clear up. And then when we get into the second half of this year, the main focus is going to be on the Tax Cuts and Jobs Act, which is a benefit for the market. So again, first quarter of this year, even first half of this year, expect a lot of volatility, but don't be afraid to look at your portfolios for the long run and invest in those areas that can reward you for the risk that's there.
Coming into this year, Megan, people said that there was going to be at least a Trump put on the stock market, if not maybe a Fed put in the same kind of way, due to the stickiness of inflation. You're saying that not only is there not a Fed put, but the Trump put isn't there for now. How how much of your bet is hinging on the idea that the Trump put essentially comes on later in the year with policies that are a little bit more friendly to Wall Street?
Well, when it comes to politics and when it comes to any president that sits in the office, we're not looking at portfolios for the long run over what might happen over the next 6 months. We're looking at opportunities for the long run that are giving you, looking at the fundamentals of the U.S. economy. And even though the U.S. economy right now is weak, the long-term fundamentals of this economy are still very strong, regardless of who sits in the White House, regardless of what policies are there right now. We know that a lot of these are negotiating tactics. So it's going to seem loud. It's going to be a lot in the headline news. This is going to spook investors. But for the long run, we will get through this. We think that the Trump put that you called it, I don't think that Trump's really looking specifically at what's happening on a daily basis in the equity markets for now. But don't think that's not going to bother him forever. If this continues into the second half of this year, we may see some softening in rhetoric, and I don't know exactly what that may be right now, but he is looking forward to getting that Tax Cuts and Jobs Act extended, as well as, don't forget, we'll be coming into midterm elections before we know it.
Megan, just before you go, I just wanted to address what I think is quickly becoming a dilemma for capital allocators, and that's how the bond market might behave. What I take away from you is nothing too dramatic here, potentially a story of two halves for 2025, but the ability to absorb shocks, the capacity to absorb shocks in this economy has been reduced over the last 12 months. And with that in mind, I want to think about the events elsewhere. Do you think the events elsewhere, particularly in Germany, maybe reduce the risk mitigation characteristic of bonds here in the United States? Yesterday was curious to me. I've seen other days like this over the last week where bonds haven't offered me that ballast when equities have started to move down, when we've seen that risk-off story. At other times it's worked, other times it hasn't. It hasn't been reliable. Megan, what's going on there, and how do you think about that going through the first half?
So we have to look at bonds as a whole and take out the tariffs. And right now, bonds are reacting on the threat of inflation. So you're seeing some of the long end of the curve globally start to rise. And there can be correlations when you see moves in global interest rates. So we saw that, for example, yesterday here in the U.S. When it comes to using bonds as a safe haven, you have to be very careful that this is the first time in a very long time that we've had to be looking as an asset allocator, that we've had to consider the fact that long-term bonds may not be the hedge because of the inflation risk. These are things we've typically used when you're heading for an economic slowdown as a way to hedge against your equity exposure. But that long end of the curve, not only here in the U.S., but globally, is being impacted by the inflation expectations. So you can still use bonds as a hedge. Just stay defensive. Right now, cash and short-term bonds are earning you a nice yield, yields we haven't seen in a while. So there's no reason that you need to extend duration out significantly to really hedge your portfolios. You can balance that out in a short, intermediate term part of the curve.
Megan, appreciate the clarity. As always, it's good to catch up. Megan Horniman there at Verdant's Capital Advisors. Just finishing on the bond market there. We've seen this a few days now, haven't we? The bond market behaving in an unpredictable way.
The more jumpy the market becomes on the stock side, bonds are also selling off, and you're seeing that with yields continuing to climb for yet another day in the United States. Raises a question about why would you invest in long-term bonds if you can get a nearly similar yield, at least, in the short term of the curve, and that's what you hear.
Equity futures this morning down about 1/10% now. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Alibaba has released a new AI model, which it claims can read emotions. The R1 Omni is said to be capable of inferring a person's emotional state from a video and also describe their clothes and environment. It's free for download on the AI development platform Hugging Face. Dollar General shares in the pre-market trade up 5%. It forecasts sales with a top end that was higher than estimates. It also announced plans to close 96 of its namesake stores and 45 pop shelf stores. Dollar General said that consumables like groceries are now accounting for a higher proportion of sales. The Thai hospitality group that owns hotels featured in HBO's The White Lotus is eyeing expansion into the U.S. Since the third season's premiere, direct online bookings for the resorts have increased by 41% versus the same period last year. Minor International plans to expand to 1,000 hotels by 2030. And that's your brief. John.
Danny, thank you. Lisa, no spoilers. Just had to get that in really quickly.
Thank you so much, because I haven't seen it yet.
I know.
Okay, I haven't seen it yet either. There's only one person here who's seen it. So who's the story catering to?
I'm not going to spoil it. I'm not going to spoil it.
Yeah, but he
we'll
doesn't
say
spoil.
This. Okay.
You come out and always tell us the end.
I gang up always. It was once. Sorry.
Don't do it again. All right?
Let's
Season
move on.
1 was better than 2. 2's better than 3. Just going to throw that out there, right? Up next on the program, countering countermeasures.
European Union's been very tough. And it's our turn, too. You know, we get a turn at that also.
Season 2 ruined Sicily. That's the problem.
But that was a better season.
Town, I mean, it was
the
like
clothes,
this nice, sleepy town 20 years ago. Now it's too busy. Anyway, let's talk about trade. Up next on the program, the former Trump White House trade official, Katie Kalukowicz, joins us next from New York. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
So later this morning, another read on inflation. We get PPI at 8:30 Eastern Time. You get jobless claims too, so look out for that. Going into it, your scores look like this. Equity futures on the S&P 500 negative by 0.2%, rolling over just a touch in the past 30 minutes or so. On the Nasdaq 100, we're down by 0.3. At the surveillance this morning, we're countering countermeasures.
When you put more tariffs on the EU, will you respond to their retaliation?
Oh, of course I'm going to respond.
You will retaliate.
The problem is our country didn't respond. Look, the EU was set up in order to take advantage of the United States. The European Union's been very tough. And it's our turn, too. You know, we get a turn at that also.
So here's the latest this morning. President Donald Trump saying the United States will respond to EU countermeasures against his 25% tariff on steel and aluminum, but not specifying what measures he would take. This as Canada strikes back with its own 25% tariffs on over $20 billion of American goods. Joining us now from the nation's capital, Tyler Kendall. Tyler, I'm losing track of who's putting countermeasures on who and who started what. Tyler, are you keeping track of this?
Yes, John, good morning. It is a lot to keep track of, but one thing that we do know from the White House, when they say they are going to respond, one through line that we've been noticing is that when they say there will be retaliatory measures against the retaliatory measures, that has to do with rolling those calculations in to those reciprocal tariffs that we are expecting on April 2nd. That is where senior administration officials keep pointing us to. And another headline out of the Oval Office yesterday, President Trump saying that once that date rolls around, there is going to be very little flexibility. And we have to remember what these countries countries are negotiating against. Perhaps on Canada, it started to be about border policies yesterday. It officially became about national security concerns when President Trump invoked Section 232 for the steel and aluminum tariffs. But broadly speaking, this administration is pushing that this is about rebalancing trade and lowering those tariff barriers. And President Trump seems to have a special ire for each of these countries, whether that is Canadian lumber or dairy or EU autos and pharmaceuticals. But importantly, John, we have to keep in mind in the background of all of this, the White House is pushing that this is about longer term growth, which goes hand in hand with their fiscal agenda. That is why they say that they need to have these tariffs in here to get that revenue raising, a revenue in order to balance that trade, those tax cuts that this White House would really like to see pushed through.
The main event about 2 weeks away, reciprocal tariffs just around the corner. Tyler Kendall there in Washington, D.C. Tyler, thank you. That's the issue we've all got. Is it about revenue raising? Is it about market access? Is it about the border, fentanyl, immigration? Is it about a personal dispute between two leaders? What is it about?
The problem is if you try to find consistency, if it's revenue raising, then there should be a bit of a concern with any kind of economic downshift, right? If you have a slower growth environment, you're going to be bringing in fewer revenues from taxes. So it's hard to wrap your head around in any given day, but I love the idea of can you keep track? And when you say the big event, I'm not sure what you're talking about. Is it the government shutdown?
April 2nd.
Is it April 2nd? Is it going to be reciprocal tariffs? Is it going to be, I mean, really, there are a lot of main events.
Their words, not mine. They say it's going to be the big one.
I know.
The big one's still to come next month.
Spoiler.
Joining us now, their spoiler, the former Trump White House trade official, Katie Kalukowicz. Katie, welcome to the program. Katie, really hard question. In 3 weeks from now, where do you think we'll be?
That is a really hard question. Thank you for asking it, and thank you for having me. I think we're going to have some more tariffs, though I think in reality, as you've probably heard from previous guests, the implementation of a reciprocal tariff arrangement with the rest of the world is quite difficult to accommodate and implement. The United States, of course, like every country, has thousands and thousands of goods that enter under various tariff rates from over 100 countries. So I think what we're going to see is the president really focus in on some of what he considers to be the worst offenders. And unfortunately for some of our allies, like the ones you were just discussing, I think they're right in the crosshairs.
But when it comes to the U.S. weighted average tariff rate, it's 1.5%. The European Union is 1.6%. Japan's 1.35%. Who was this administration really going after?
It's a great question because, of course, you're exactly right. Our average tariff rates are quite low, but the president has been fairly explicit, and frankly, the United States has been explicit for a long time, that in the economies that you've mentioned, it's the non-tariff barriers that are really a concern. You know, in the European Union, for example, we have difficulty selling our agricultural goods because of regulatory barriers. In Japan, we have issues selling cars. Despite a 0% tariff rate on automotives, we struggle to sell our cars there because of their regulatory barriers. So you're right to focus on the tariffs. I do think that we will see some, tit for tat on tariff rates, even if it's a small amount. But the president has directed his government agencies to calculate the harm of these non-tariff barriers, ostensibly to come up with a corresponding tariff rate.
Katie, if you're an investor, on April 2nd, do you see the actual tariffs or you just see basically the tariffs get publicized and what they plan to do?
I think we're going to see a range of actions. If you go back to the first document that outlines the president's goal here, the America First Trade Policy Memo, which he issued on day one of his administration, you will see directions to a wide range of agencies which have a wide range of tools. I think we will see a number of new investigations. The president has, of course, already launched some with respect to timber, lumber, and copper. I suspect he will be looking at additional strategic sectors. Semiconductors and cars come to mind, as do pharmaceuticals. I suspect he'll use the 301 authority, which is what launched his first trade war with China, to look into some of these more pernicious barriers. And then I think we may see, exactly as you described, new tariffs that respond to the differential tariff rates in certain economies.
Kate, you were in the previous Trump administration. How different is this Trump administration's approach to trade, to tariffs, than when you were in the White House?
You know, what strikes me most is a little bit about what you were talking about previously. which is just it's the speed with which some of these things are coming. The question about the motivation. I mean, as you said, the president has talked about tariffs in response for fentanyl, in response for the border, in response for reciprocity. I mean, they are coming so fast that I think even our trading partners are trying to catch up. They're trying to understand, what will this president respond to? Is it a deal, as we all had anticipated and come to know in the first term? Or is that simply a fool's errand? And I think for our allies in particular, they're really struggling first with coming with olive branches, trying to offer a deal. Second, to try to match the president, which, as we saw, did not work well for Canada. I fear it will not work well for Europe. And then maybe a bit of recognition that this is the new reality and trying to settle in and bear down. It is different in that respect, because it does not seem, at least at the immediate term, the president is interested in a deal right now.
Kate, appreciate your perspective on things. Difficult questions to answer. Where are we going to be in 3 weeks' time? Kate Kalukowicz there, the former White House trade official in the Trump administration in the first term. So, Lisa, I would say speed and sequencing. To Kate's point, it's moved really, really quickly this time around. The sequencing, of course, is different. They've started with trade. Last time they started with taxes. I think there's another big difference as well. This 4-year gap between the first term and the second term, the president has had time to think. Had time to think about what he wants to do. He also understands the levers of government in a way that he didn't before coming into the White House. And he's moving much more quickly because of those things, I think. They all just line up. It all just stacks up perfectly for him to hit the ground running in a way that he has done.
And he says that he has a plan, and the entire administration gives us the longer-term trajectory. What Kate was saying there, though, her last point was really telling, which is it doesn't seem like he's interested in making a deal right now, which makes it that much more complicated.
He's in negotiating mode. You have to think, though, 3 pillars of the Trump administration. It's going to be trade, low regulation, tax cuts. How do you do this all when you can't control the timing of at least one of the big ones?
Up next on the program, we'll catch up with the former New York Fed President Bill Dudley on why he thinks markets are underestimating tariff risks.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street.
We're
basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Do you remember when Lisa ruined Shogun?
Oh my God.
I do, because I never watched Shogun.
Really? You've got nothing else to talk about.
Brutal.
Really, there's enough going on in this world.
That was a tough day.
I didn't end up watching because I just thought, what a waste of time.
Lisa basically told you the end.
I think I'm gone now. See you later.
Equity futures on the S&P. You'll be missed. Don't go anywhere. Equity futures on the S&P, negative by about 0.2%. Lisa will be missed because later on this morning, we'll have some economic data, PPI, in about an hour from now. Jobless claims as well in 30 minutes' time. Don't miss this conversation. We'll catch up with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time. That's 30 minutes away. Don't miss it. We're 2 hours away from the opening bell. Let's get you some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Intel. Finally, a new CEO over there, and the market likes it. Shares are up 11.5%. Lip Bhutan will be at the helm, and his strategy is to stick with the current plan of making chips for other companies. Yes, it has been a costly endeavor, and one that even led to the ouster of his predecessor, but he thinks he can execute, and so does the street. B of A upgraded the stock from underperformed to neutral, and a number of other analysts are reacting positively. Next up, we have Adobe shares. Those are moving in the other direction, down 5%, after the company behind Photoshop gave an outlook for the current quarter that failed to excite investors at a time when they're looking for progress from Adobe on monetizing all those investments they've made into generative AI, but it's not happening as soon as they'd like. And last up, we have shares of American Eagle. Those are plunging 9.7% after issuing weaker than expected guidance for the year ahead and signaling that tariffs are going to hit margins. Plus, it's the latest company warning us that the consumer is pulling back. John?
Yahara, it's another one. We've heard from a few. Appreciate it. More from Yahara in the next hour or so. 3 of the names to watch going into the opening bell. 2 hours away. On our radar this morning, the US budget deficit hitting a record in February. The biggest contributors to the continued widening Medicare costs and servicing government debt.
So this is a big problem because they are trying to, one, bring down the deficit and then also make way and room for the $4.55 trillion of extending TCJA and maybe adding on some of these taxes provisions that the president talked about on the campaign trail. And this number just makes it that much harder because guess what? You can't really control the interest. And also, the president says he's not cutting Medicare.
If this market were pricing in the complete package of this White House, of potentially what could amount to more than $5 trillion of tax, of basically deficit increases over the next 10 years at the same time as tariffs, yes, with the tax cuts involved, how would that mix look like in markets? Would it be a benign outlook? Would it give a boost to the consumer? Yes, probably. But how much would it also kick up the long end of the yield curve in a way that I know Scott Bassett wouldn't want to see?
Well, from a market perspective, arguably that was the story of November, December, and then all of a sudden things changed when we started 2025.
And the real question now is, if they do make traction in the Senate, in the House, how much does the market start to reprice that, or have some of the other developments taken that off the table for now when we're talking about whether or not the government will shut down tomorrow night?
Well, let's get to the shutdown, and I think that's going to be the main story for a lot of people. Before we even talk about taxes, we need to talk about this. Senator Chuck Schumer saying his party will block a GOP bill to avert a government shutdown on Saturday. Schumer urging Republicans to instead accept a Democratic plan to fund the government through April 11th. His view is quite simple. You don't have the votes. If you don't have the votes, you need to negotiate.
Right. So they want to have at least 24 hours, I believe, of this negotiation. What do you get in the end? Potentially, they will be able to have an amendment where they vote on and show politically we wanted something different that the Republicans are trying to push through. But if they hold the line and we go through a shutdown, everyone in Washington, D.C. will get blamed for this, the Democrats and the Republicans.
It's a really difficult moment for the Democrats to know how to finagle it. A lot of people are saying, look, we have to get on board because we don't want to shut down the economy right now, given all of the other potential risks out there. At the same time, it is a difficult moment for them to take a stand when they don't have the leverage.
The Democrats cave, or Republicans cave, and come to the table, or the Democrats say, look, we're not going to deal with this mess because it's going to be too much blowback on us, and we need to find a more consistent message to go after the administration and the Republicans than just saying we're going to shut down the government.
Our favourite story will continue into the weekend. Can be sure of that. Wanted to fit this in, an important development. The FTC is moving ahead with an antitrust probe of Microsoft that was launched late in the Biden administration. The agency also walking back comments that it's not ready for a September trial, examining Amazon's Prime subscription practices, how they regulate things, and whether we can go through with a different regulator, with a different regime, I think is the big topic for a lot of people, including the banks for that matter. We thought we'd have all of these mergers and acquisitions, a softer touch, a lighter touch down in Washington. Not seeing much sign of that so far.
You might get a softer touch, except when it comes to technology. And Andrew Ferguson, the new head of the FTC, kind of taking a playbook from Lena Khan. One of his first public remarks since taking the position back in February, he said investigating the tech sector is his highest priority. And guess what? You see that here right in the beginning, 7 weeks in.
I think a lot of advisors at a lot of banks will be watching that story pretty closely. Let's turn back to the trade story, tariffs. The former New York Fed President Bill Dudley saying Trump's tariffs will be worse than markets think, writing, markets seem to think that if the president won't stop the damage, the Fed will. I think they're too complacent. Bill joins us now for more. Bill, welcome to the program, sir. Great piece. Let's talk about it. Why do you think they're too complacent?
I think the problem is that the tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty. The decline in merger activity in the 4 months of this year is pretty striking. People expected merger activity to pick up with the Trump administration. It's actually gone down because nobody knows what the rules of the game are going to be in terms of relative prices for inputs, relative prices for exports. So people are very confused and people are just sitting on their hands.
Bill, as John was just saying, you wrote this line, markets seem to think that if the president won't stop the damage, the Federal Reserve will with rate cuts. Where do you think they have the political leverage to not cut rates at a time when they are seeing quite a bit of potential destruction to the U.S. economic outlook?
Well, it all depends on what happens to inflation, how high does it go, and two, does it get into inflation expectations? The inflation expectations are the key issue for the Fed. The second thing they're going to be focusing on, how much does the unemployment rate rise? It's not about job creation. It's about the unemployment rate. One thing that people don't really understand, I think, well, is the fact that we don't need a lot of job creation to keep the unemployment rate here because the growth rate of the labor force has collapsed with the Trump administration. We're deporting workers. The number of people coming over the borders has collapsed. The growth rate of the native-born population is really slow. So top speed for the U.S. economy in terms of keeping the unemployment rate where it is probably 50,000 payroll employment a month. And I think people think that 150, 200,000, if it slows to 50,000, the Fed's going to cut. I think that's wrong.
Bill, I understand the argument that the Fed put isn't exactly there, that the Fed is going to come in and cut rates in response to market turmoil. At the same time, there is an argument that some of the tariff-related inflationary forces are one-time price adjustments that will eventually come down, especially with a weakening economic outlook, and that they can look through that a bit more and place a bigger emphasis on the unemployment rate and other economic indicators. Do you push back against that?
Well, again, it depends on whether it gets into inflation expectations. The first Trump term, the tariff increases were relatively modest. It wasn't an inflation issue because inflation was running below the Fed's 2% objective. This time, the tariff increases are orders of magnitude larger, and it's happening at a time that inflation's been running well above the Fed's 2% objective for 4 years. So inflation expectations are the key. And one troubling indicator in that regard is what the University of Michigan household expectations survey showed last month for 5 to 10 year forward inflation expectations. It rose to 3.5%, the highest level since the 1990s. So if that is corroborated by other inflation expectations indicators, that's going to make it much more difficult for the Fed.
Bill, you're talking about the upcoming economic projections we're going to get from the Fed, and you say inflation will be increased, but the path for the unemployment rate won't change much as labor force growth slows along with hiring. Are you basically saying the Fed and their projections are going to almost pinpoint stagflation?
Well, I think they have to lower their growth estimates, given the uncertainty that the tariffs are causing and the fact that it makes real income for lower income households very much squeezed, and so they're not going to be able to spend very much. They have to raise inflation because the price level of a lot of these imported goods is going to go up pretty significantly. So I think that's sort of in the cards. I think what's going to surprise people is that they're not going to raise their unemployment rate trajectory very much. And I think that people maybe be surprised that they're not going to increase the number of rate cuts that they have in their forecast. Last time they had 2 rate cuts for 2025, and I think they'll keep it right there.
Bill, let's just talk about those forecasts. What is the approach to putting forecasts together in a moment like this? How much of a conversation happens between individual policymakers?
Actually, with regard to the summary of economic projections, everyone sort of does their own. So this is not coordinated. You are allowed towards the end of the Federal Open Market Committee meeting to change your forecast based on what you've heard from others, but people rarely do that. So these things are really put into place before the meeting starts and hardly ever changed.
A lot of people expect the statement of economic projection not to really move that significantly, and if they do, for it to essentially be irrelevant because they don't know anything. Do you disagree? Do you think that it will be indicative of what kinds of scenario analysis individual members are doing and how much they're incorporating policy for their outlook?
I think the reason it matters is the fact that I think people are looking for the Fed to sort of come to the rescue of the economy by cutting rates. And you've seen it in the decline in 10-year Treasury note yields over the last few months. And I think the Fed's going to signal through the summary of economic projections and in Chairman Powell's press conference is that, no, we're sitting on our hands for the time being.
Bill Dudley with the latest. Great piece on Bloomberg Opinion. That Bloomberg column available on Bloomberg.com and on the Bloomberg terminal. Bill, thank you, sir. As always, the former New York Fed President, Bill Dudley, there on the Federal Reserve and whether that Fed put is alive and well.
And the answer is probably not as quickly as you think because the unemployment rate probably won't go up for quite a while, and that's going to be the ultimate tell for them. You asked a question earlier this morning, I believe, to Greg Dacko that I thought was really interesting. Do you think that the Federal Reserve will have the same leeway to be blunt the way that the ECB and the Bank of Canada have been in this dual kind of conflict about slowing growth and higher inflation? I think that'll be interesting to watch.
I am noticing some subtle shifts, though, since the news conference of November, December time. We shifted from we don't assume, speculate or guess to some people did assume, speculate and guess. And the recent speech actually addressed policy almost head on.
Yeah.
And I wonder if that's just the beginning of doing more of the same next week, and we'll see.
They kind of have to, because if they don't give some acknowledgement of policy that we've already gotten and of market reaction, remember the markets are one of the main transmission mechanisms of their policy. Can they now say that market turmoil is irrelevant to their outlook and irrelevant to some of their inputs? No, they're going to have to address it on some level, and I think it will be interesting.
That news conference will be must-watch on March 19th. That is next Wednesday. We'll have live coverage of that for you right here on Bloomberg TV. We are looking at futures declining by a couple of tenths of 1% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The IEA has cut its oil consumption forecast due to a slower pace of deliveries and escalating trade tensions. The agency said that global oil demand is under pressure from escalating trade wars at the same time that an OPEC Plus is reviving output, threatening to deepen a supply surplus. The IEA predicts a surplus of 600,000 barrels a day through this year. OpenAI has asked the Trump administration to shield AI companies from state regulations if they voluntarily share their models with the federal government. The company argued that AI-related bills threaten to undercut the country's technological progress. And in sports, the Champions League quarterfinals are set after Real Madrid beat their Atletico rivals on penalties. They move on to face Arsenal, who took down PSG 9-3 aggregate across 2 matches in total. Elsewhere, Barcelona will face Dortmund and Bayern Munich will take on Inter Milan. The first leg games will begin the second week of April. And that's your brief, John.
April 8th, I believe. Thank you, Danny. Appreciate the update. No one around this table apart from me wants to talk about it, so I won't even bother. Up next on the program.
Can I just say, this is like stacked. White Lotus, and now this.
I didn't put any of these stories anywhere. Maybe there's someone interested in the control room.
Yeah. Oh, yeah.
Some of this.
Big time.
Yeah. Who likes European football.
Yeah. Spoiler.
Why are you so angry about it? That's what I'm trying to figure out.
Well, you still tried to out me and, make my...
Out you for anything.
Yeah, for spoiling. You outed yourself.
It's all right. Stocks are down. Okay? It's okay. Up next on the program, U.S. exceptionalism at risk.
U.S. exceptionalism is over in our mind. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
We'll get the view of Citi in just a moment. Dirk Willer joining us in just a second after downgrading U.S. equities in the past week and looking to China. That conversation up next.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The economic data is just around the corner, 8:30 Eastern time, so about 43 minutes from now. And going into that, equity futures drifting down towards session lows, just slowly over the last hour or so. We're down by 0.4% on the S&P. On the Nasdaq 100, we're down by 0.6. Under surveillance this morning, U.S. exceptionalism at risk.
U.S. exceptionalism is over in our mind, but this is a decade-long. I mean, look at how much money came into the U.S. So I do think that the exceptionalism story is over. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
So here's the latest this morning. The S&P 500 on track for its fourth consecutive weekly decline as growth concerns put U.S. exceptionalism at risk. Dirk Willer of Citi writing, in the coming months, we expect U.S. growth momentum to undershoot the rest of the world. We therefore downgrade U.S. equities to neutral, upgrade China to overweight. Dirk joins us now for more. Dirk, good morning. Good to see you.
Good morning.
Let's start with the downgrade on the U.S. side. Let's talk about why. Why?
I mean, we overall downgraded equities actually already in February from overweight to neutral. For us, it was just a question, what are the overweights, what are the underweights inside this more neutral stance, right? And I think for the US, the data will remain weak. I mean, it only has started, really. The data momentum usually is weak early in the year for many reasons. It tends to trough at around late April, May. You on top of that have actually poor seasonals for the S&P going into tax payment season, so early April is usually a bad time when there was a lot of capital gains in the previous year. And more importantly, I think a lot of the economic data, especially on the job market side, is only to come. I mean, our economists called the last job report the last good job report, and it wasn't a great job report, right? It had some weakness under the hood, but it was the last decent one because we expect 300,000 plus in terms of Doge numbers. We expect 70K from people who took the buyout in the government, and that will happen in May, maybe stretch to September. The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
Can we just sit on that weakness? What kind of weakness are you expecting? Are you expecting recessionary conditions, just below trend growth? What are you expecting?
It's a slowdown, right? And we are not in the recession camp. Our GDP forecast for the year is just above 1%. And therefore, we're not predicting, you know, for 20% pull down in the S&P, you need a recession, right? We are not expecting that. For us, it's a question, who is the leader coming out of this? And we just don't think it will be the US because, you know, a couple of things happened, right? Where we are upgrading European growth, we are upgrading Chinese growth at the same time when US growth is subpar. So it's a relative bet more than saying it's a U.S. recession call.
This is an important point, especially at a time where a lot of people have come on the show and said the weakening was already in place before some of the policy uncertainty. And that's an important issue at a time when potentially other countries are responding with stimulus, and I'm talking about China and Europe. Just how much is this call being driven by what's going on in China and to some extent in Europe, more than what uncertainty or negativity there is in the U.S.?
Yeah. I mean, it's both, right? I mean, the reason, for example, the big German fiscal stimulus, I think you can see it as glass half full, glass half empty. Well, it's probably more glass half full, but if it hadn't come at exactly the same time where the US data is also slowing, people would not have bought as many euros as they did, right? So it came, the German stimulus came at the perfect time for that trade coinciding with a weaker US view. And similar in China. I mean, China has not hit us over the head the same way that Europe did in terms of big fiscal bazooka, but they also have done something under the hood. They're also doing stabilizing measures, and more importantly, President Xi actually wants the equity market to go up, right? So the Xi put is closer to than the Trump put in a sense, and so we are upgrading GDP in China, and it's really interesting. The best performing equity markets this year are the ones with the biggest target on their back for tariffs, right? It's China, it's Europe, even Mexico and Canada tremendously outperformed the S&P, and I think the reason for that is it's the opposite from 2018. In 2018, the US outperformed and China obviously underperformed. And I think the main reason here is that in 2018, the US mostly targeted China. And if you just target one country, then that country underperforms and the US can source the imports from many other places. And so it's just not that bad for the US economy. If you target everyone, it's just more difficult for the US to manage through that. And for the other countries on the margin, maybe slightly easier in relative terms.
To that point, yesterday, loonie was the best performing G10 currency against the dollar, which I thought was really interesting on a day when some of these trade concerns were heating up. Why China? Why not Europe?
It's a good question. And the stories are similar in the sense in that we're upgrading growth numbers in both areas relative to the US, right? So you could say, okay, if it's mostly about that, why don't you go for Europe as well? And Europe has performed really well, and actually our European strategist caught the trade. So it's not that it's a very good question, basically. The reason why we picked China is really that we think eventually the AI story will come back. We think right now it's probably not the time to press it, but in the very big picture, it seems to me the top in the market is really only in when the AI story is over, and we don't think it's over yet. Now, the stock markets with AI assets are, of course, China and the US. Right? And so that's why we gravitated to China.
When it comes to China, though, there's an additional 20% tariffs added on Chinese goods into the United States, and they're not going away right now, and potentially they can get higher. Does that not concern you?
It is concerning, and that is obviously the main pushback to the call, right? Why do you pick something where tariffs could go up? What I would say is, one, we already had 20% tariffs, as you point out, and what happened is interesting. What happened is inflation expectations went up. Some stocks in the US that import a lot from China sold off, and Chinese equities are broadly speaking at the highs. So you can see how the market has taken the tariff so far. Now, clearly that could change going forward, and there is tariff risk. But remember, we have it as part of the neutral equity allocation, where on the other side we are short Japan. My guess is if tariffs come aggressively, Japan would not be spared, and so in the end, it's a bit of a hedge too. But I must say it's amazing how little happened so far given the tariffs we've seen.
That's the equity picture. Can we just finish on bonds? What are you meant to do with the bond allocation at the moment? What do treasuries do in a portfolio for you? What are they there for?
And there we also unwound earlier the US exceptionalism trade. The US exceptionalism trade was really treasuries will underperform because that's where the strong growth is, that's where yields go up a lot, and bonds and so forth outperform, right? We unwound that. We got a bit lucky and did it before the German big sell-off. And so at this stage, the trade we have is we're still underweight Japan, because I think that story will keep playing out, and our overweight at this stage is the UK. So the UK doesn't have the same fiscal issues as the US, as Germany, and is also a bit of a laggard. We like to receive, but we prefer to not receive in the US because the Fed is just hemmed in by the inflation picture. Instead, we want to receive in places that have been lagging in the interest rate cycle. So for us, that is the UK of the bigger markets, but we also received in Mexico, and received in Australia. We love Turkey. So there are a bunch of things where we think they're better receivers, but we're trading it from the receiving side. So we prefer long bonds and short bonds, just not necessarily in the US.
Interesting. Thoughtful stuff there, Dirk. Appreciate it, sir. Thank you. Dirk Willer there of Citi, just on the bond market, trying to figure out where to be, where not to be, and why.
And a reversal, essentially, of the Trump trade from last year. And that's an interesting one at a time where a lot of people aren't sure how to play. Deficits, tariffs, growth, it's confusing.
We've totally rewritten the post-election playbook in financial markets across all asset classes. Coming up shortly, in the next hour of Bloomberg Surveillance, Tracy McMillan of Wells Fargo, Neela Richardson of ADP, Kayla Cedar of State Street, and a conversation with the Commerce Secretary, Howard Lutnick, coming right up from New York City. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it on the China Show.
Compared to a 10% tariff on Chinese exports to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek did was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
We've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and here's the price action. Equity futures negative by 0.25% on the S&P 500. On the Nasdaq, we're down by 0.4. On the main event this hour, 30 minutes away, the economic data. Look out for PPI, another read on inflation in America. Look out for jobless claims. How is the hard data? What is the labor market picture right now as we confront the prospect of more trade tariffs? We'll be catching up in just a moment with the Commerce Secretary, Howard Lutnick. Howard Lutnick, just around the corner.
And it comes at a time when we do get these dueling tensions in the market, and a dueling tension that we see in the data coming up, potentially where you could see inflation stickier while you have unemployment, or at least jobless claims ticking back up. That is the expectation. How does Howard Lutnick, the Commerce Secretary, respond to concerns in markets that they say are okay with them? A disturbance, a detox, as long as they get to the ultimate place. At what point does it become a concern?
So he's got to meet the Canadians a little bit later, and the objective of that, according to the Commerce Secretary, is to bring down the temperature on things. Might have to bring down the temperature on things between the United States and Europe as well. The President of the United States posting on social media just moments ago, the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world. That post coming just moments ago.
He's saying that because they have a, quote, nasty 50% tariff on whiskey. He says if this tariff is not removed immediately, the U.S. will shortly place a 200% tariff on all wines, champagne, and alcoholic products coming out of France and other EU-represented countries. The temperature is just going up. You have to think this must be negotiating mode for what he calls the big day, which is April 2nd, but it's uncertain and it's frenetic.
It's lunchtime in Paris, France, and I think the president just turned to his assistants and said, 1-800 Donald Trump, please. the president's on line one.
So this, to me, is a real question about what the ultimate goal is. Is this a negotiating period ahead of April 2nd where they try to get things in stone and kind of get better leverage before that? Kate Kalukowicz, who was on earlier, who was part of the Trump administration 1.0, said that this is different because it is unclear what the goals are and what deal this president wants to strike. That is ongoing when you get truths like this.
This is for sure a maximalist approach when it comes to President of the United States and tariffs. And the issue the market is having and digesting is this is only one part of the entire Trump agenda. Deregulation, not really completely priced in yet, and we don't have the extension of the tax cuts yet, or more tax cuts added on top of that.
So honestly, at this point, what I'm looking for is how much does the market start to say the uncertainty in and of itself is going to become a feature and not a bug? And do we get some resolution on April 2nd, or does this just prolong that uncertainty as we continue with negotiations?
Some important economic data coming up as well at 8:30 Eastern Time. We need to talk about PPI after seeing CPI a little bit earlier in the week. This tees up the Federal Reserve's meeting next week. And as we've talked about extensively, they've got to put out some forecasts on March 19th. It's going to be so difficult to put out those forecasts and then walk into a news conference, Chairman Powell, face down reporters, question after question about policy and what it means for the outlook.
You know, Bill Dudley put it really well, and formerly of the New York Fed. I thought his comment on why it is important to watch the statement of economic projections was telling. It gives you a sense of their reaction function, of the idea of if they expect the idea of inflation coming up and you get some sort of slowdown in growth, do they, on the margins, expect to cut rates, or do they hold firm and try to counter inflation to a greater degree?
This is the concern for higher tariffs for a lot of people. It's both could be inflationary, even if it's just one-time price hike, which Scott Bessent has talked a lot about as recently as the Economic Club of New York, but also hurting of growth, meaning Dudley's talking about the fact that you could see a dot plot that kind of insinuates we might have stagflation coming to America.
And this is something that central banks around the world have been grappling with. We heard that from the ECB, from Christine Lagarde. Yesterday, we heard from the Bank of Canada Governor Tiff Macklem, where he did lower rates by 25 basis points, the bank did, but indicated it might be the last and it might be kind of tricky going forward, saying the trade battle between the U.S. and Canada is a new crisis. And that right now there is pervasive uncertainty and the path forward might be tricky as they face off with the potential for inflation ticking up and growth ticking down.
Let's bring in Tracy McMillan into the conversation. She joins us from Wells Fargo. Tracy, welcome to the program. Lots of important economic data later this morning, but just set the stage from your perspective, what this trade story means for you personally and for the team, and how you're approaching markets with that in mind.
Sure. So obviously, the tariff comments and the tariff policy on again, off again is impacting the sentiment of consumers. So we're looking at it from that perspective. At this point, this is not setting up like a typical recessionary period because it's being preceded by the weaker sentiment from consumers and not being preceded by weakness in fundamentals. Typically, what we would see is that earnings projections start to fall. We may see concern that companies are unable to finance their debts. So we see high yield spreads widening out. We're not really seeing that kind of reaction right now. So that tells us that this sell-off right now is mostly predicated on weaker sentiment, that if tariff policy were enacted as in some of the more extreme fashion that we're hearing about, that is what could probably lead to more concern about economic growth going forward. But we really think that this will be resolved fairly quickly and we'll move on to the more positive aspects of policy.
Tracy, you came into this year overweight U.S. assets, overweight the dollar, overweight on stocks. I just wonder how long you're willing to wait before you change your view, or you have conviction in going in right now and buying on this dip.
So we do have conviction. In fact, we just recently made an adjustment to our allocations where we pulled back some of our allocation to intermediate term fixed income, and we moved that over to mid-cap stocks. What we're seeing here is capital gains in our fixed income holdings that we want to take advantage of, move that into a segment of the U.S. market that we think could benefit from some of the policy action in the second half of the year. So we think that once we get past some of the tariff negotiations, that CEO confidence will be revived. That could lead to additional mergers and acquisitions. That could benefit mid-caps. And we also see that mid-caps are almost as high quality as large caps, but often they get lumped in with small caps, which are much lower quality.
Tracy, appreciate your view on the market. Tracy McMillan there of Wells Fargo. Just to bring you an update on the markets right now, equity futures on the S&P 500 down by 0.4%. No real drama there. In the bond market, bond yields are higher by 2 basis points, 433. Just want to note, a little bit of economic data later, 8:30 Eastern time, 22 minutes from now, you'll get US PPI and you'll get jobless claims as well. If you are just joining us, welcome to the program. Let's turn back to global trade. Canada striking back against President Donald Trump's metals tariffs, slapping 25% levies on over $20 billion of American goods. Canadian officials coming to the bargaining table today. You'll hear from the Finance Minister, Dominic LeBlanc, and the Ontario Premier, Doug Ford, set to meet with the Commerce Secretary, Howard Lutnick. And I'm pleased to say that Commerce Secretary Howard Lutnick joins us now from Washington, D.C. Mr. Secretary, welcome back to the program, sir. Always appreciate your time. If we could just take a step back and set the table, what are the stakes for today's meeting between you and Canadian officials?
Well, I think the stakes today, if you take a look at it from the big picture, is the United States said we need to have steel and aluminum domestically in America. In national security, you need metals to make bullets, you need metals to make munitions, you need metals to make everything. And Donald Trump is very focused on, let's make sure the key ingredients that are necessary to defend America are made here in America. And these other countries, they just don't pay attention. I mean, how many times do I have to say national security is important? And if you do like the EU and you respond by putting a tariff on Kentucky bourbon, which used to piss off Mitch McConnell, which doesn't really matter anymore, you got to wonder, really, do I have to deal with this stuff? But alas, we do.
Mr. Secretary, let's get to Europe in a moment. Let's just stay on Canada, and then we'll work our way to the EU if we can. For the Canadians, as you know, they've put tariffs on around $21 billion of US goods. Will that change your approach to today's meeting?
Well, I mean, take a look at that again. Let's take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect